In the world of investing, the concept of risk and return is a fundamental principle. Generally, the higher the risk, the higher the potential return. This idea is based on the premise that investors demand greater rewards for taking on greater uncertainty. The reasoning is simple. If you're willing to put your money into something that could lose value or be highly unpredictable, you should be compensated for that risk with a better return. However, this theory does not always hold true in the real world. There are instances when safer, lower-risk investments outperform riskier ones over extended periods. This paradox challenges the common assumption that risk and return are directly correlated. To better understand this phenomenon, let's examine some examples where safer assets have outperformed riskier ones and explore why this happens. One of the most well-known and often cited examples is the long-term performance of U.S. Treasury bonds compared to stocks. U.S. Treasury bonds, considered one of the safest investments, have historically outperformed stocks over certain periods. For instance, over the past few decades, investors in U.S. Treasury bonds have enjoyed consistent returns, while stock markets have experienced volatility with some extended periods of poor performance. The stock market's higher risk did not always translate into higher returns. A major reason for this paradox is market cycles. While stocks can provide higher returns in the long run, they also go through periods of significant downturns. During economic recessions or times of financial instability, stocks can drop in value sharply, even losing half or more of their worth. On the other hand, bonds, particularly government bonds, tend to be more stable. During these times of market volatility, investors often flock to bonds as a safe haven, driving their prices up and offering strong returns. This cycle can create periods where bonds outperform stocks, even if stocks have greater potential for returns when times are good. Another example can be seen when comparing large-cap stocks to small-cap stocks. Small-cap stocks generally have greater growth potential due to their smaller size and the ability to grow rapidly. However, they also come with greater risks. Despite this higher potential, large-cap stocks, which are typically more stable and well-established companies, often provide more consistent returns over time. In periods of economic uncertainty, large-cap stocks tend to perform better because they have more financial stability and better access to resources. The performance of safer investments like bonds or large-cap stocks can also be enhanced by macroeconomic factors. For example, during periods of low interest rates, the yields on bonds may be lower, but the demand for bonds can increase as investors look for safer assets with guaranteed returns. Additionally, low interest rates often coincide with periods of market instability, where investors flee to safer assets. This means that the riskier assets, like stocks, may not be able to deliver the kind of returns investors expect, while the safer bonds still provide steady returns. One of the most notable periods where safer assets outperformed riskier ones was the aftermath of the 2008 financial crisis. Following the crash, stock markets took a long time to recover, with many investors losing significant amounts of money. In contrast, government bonds, especially those issued by stable countries like the US, delivered consistent returns. This paradox can be explained by the fact that during times of financial crisis, investors tend to become risk-averse, and safer assets become more attractive. Thus, riskier assets like stocks do not always offer higher returns, especially when the market is in a downturn. Another contributing factor to the risk-return paradox is the behavior of individual investors. Many people are drawn to the potential for high returns offered by riskier investments, like stocks or startup companies, but they often fail to account for the risks involved. This can lead to a situation where, despite the higher risk of these investments, they may not always provide the higher returns expected, especially when considering the impact of market timing, investor behavior, or the timing of economic cycles. The safer assets, on the other hand, tend to offer more predictable returns, even though their upside potential is more limited. It's also important to recognize that the concept of risk itself is not always straightforward. What constitutes risk to one investor may not be the same for another. For instance, an investor who has a long-term horizon and is not concerned with short-term fluctuations may view stock market volatility as a normal part of the investing process and be willing to accept the risk of occasional losses. On the other hand, someone closer to retirement may view those same fluctuations as a significant risk to their financial well-being and prefer the stability of bonds or dividend-paying stocks. There is also the factor of diversification. One of the main strategies to manage risk is through diversification. By spreading investments across different asset classes, industries, and geographic locations, investors can mitigate the risk of large losses. Diversified portfolios tend to perform better over time because they reduce exposure to the volatility of any single asset class. While an individual risky asset might perform poorly in the short term, a diversified portfolio may not experience the same degree of volatility, potentially leading to better long-term returns. In addition, the concept of volatility is crucial in understanding the risk-return paradox. High volatility, while often associated with high returns, can also be detrimental to long-term wealth accumulation. For instance, during volatile market periods, investors might make emotional decisions, such as selling stocks when the market is low and buying them back when prices rise. These kinds of actions can erode returns and lead to worse outcomes than if they had invested in safer assets. Even if riskier assets offer higher potential returns, volatility can discourage investors from holding onto those assets for the long term, resulting in lower actual returns. In conclusion, while the traditional theory of risk and return suggests that higher risk leads to higher returns, real-world examples often defy this assumption. Safer, more stable investments can outperform riskier ones during times of economic uncertainty or market instability. The key takeaway is that the relationship between risk and return is not always linear, and investors must carefully consider their own risk tolerance, time horizon, and the current economic environment before making investment decisions. Holding cash is often seen as a safe and flexible way to manage your finances. It provides you with the ability to quickly respond to opportunities or emergencies, allowing you to make purchases, invest, or handle unexpected expenses without needing to sell assets or take on debt. In theory, cash offers comfort because it is easily accessible, liquid, and free from the fluctuations of other investments like stocks or real estate. However, as the value of money is eroded by inflation, holding cash for long periods actually leads to a loss of purchasing power, creating what can be referred to as the cash paradox. While cash provides short-term flexibility, over time it guarantees a gradual, silent loss of value. The first layer of this paradox is that while cash allows for immediate action, it doesn't keep pace with inflation. Inflation, which is the increase in prices for goods and services over time, means that a dollar today will not buy the same amount of goods and services in the future. Even in a stable economy, inflation can erode the value of cash by a small percentage each year. For example, if inflation is running at 2% annually, the purchasing power of your money will decrease by 2% each year. That means if you hold $100 today, in 1 year it will be able to buy goods and services that would have cost $98 today. Over time, this seemingly small decline in purchasing power can add up, and if you are holding cash without earning interest or investing it elsewhere, your money loses value. In practice, the impact of inflation on cash holdings becomes more pronounced in an environment of higher inflation. During periods of economic instability or rapid inflation, the erosion of purchasing power can accelerate. In the 1970s, for example, the US experienced a period of high inflation, with annual rates sometimes exceeding 10%. If you held $1,000 in cash during that time, you would have lost $100 or more in purchasing power each year, depending on the inflation rate. In this case, holding cash wasn't a safe haven at all. It was a losing proposition. Even though cash provides flexibility and ease of access, it doesn't protect you from the rising cost of living. The second layer of the cash paradox is the opportunity cost of holding cash. When you hold cash, you're essentially putting your money into an asset that yields very little, if anything at all. In a savings account with low interest rates, your cash may earn a fraction of a percentage point. While this seems harmless in the short term, over years or decades, the growth potential of that cash is minimal. On the other hand, other investments such as stocks, bonds, or real estate have historically provided higher returns. Although these investments come with risks, their long-term returns tend to far outpace the inflation rate, allowing investors to grow their wealth over time. By holding cash, you are sacrificing the potential for greater returns and the chance to protect your purchasing power from inflation. For example, imagine you have $10,000 in cash and leave it in a savings account earning 0.5% interest per year. After 1 year, you will have earned $50. However, if inflation is 2%, the purchasing power of that $10,000 has effectively shrunk by $200, leaving you with $9,800 in real value. Even though the nominal value of your cash has increased, its purchasing power has decreased. If you had invested that $10,000 in the stock market or a real estate property with an average return of 6% per year, your wealth could have grown substantially over the same period, easily outpacing inflation and yielding both nominal gains and real growth in purchasing power. Furthermore, while cash provides flexibility in the short term, it can also contribute to long-term financial stagnation. For individuals or businesses who consistently hold onto large amounts of cash rather than deploying it into productive investments, wealth creation becomes more difficult. The longer the cash sits idle, the greater the opportunity lost. As inflation rises, the gap between cash holdings and other forms of wealth generation only grows wider. In the worst-case scenario, someone who holds cash over an extended period without earning interest or investing it elsewhere may find themselves worse off than if they had taken on some risk and invested the money in assets that appreciate over time. There is also the psychological aspect of holding cash, especially during times of market volatility or economic uncertainty. Cash is seen as a safe haven, providing a sense of security during times of instability. This is a natural human inclination. During times of crisis, people often flock to cash because they view it as a more stable asset compared to stocks, bonds, or other investments. This behavior can be particularly noticeable during financial crashes or recessions when investors fear losing their money in riskier assets. While cash does offer stability in such times, it also prevents investors from capitalizing on the opportunities that arise during market downturns. Investors who panic and move their money into cash during a downturn may miss out on the recovery that often follows, leaving their wealth stagnant, while others who remained invested in the market see their portfolios grow as the economy rebounds. In fact, some of the wealthiest individuals and successful investors have made their fortunes by investing in assets that provide greater returns than cash, especially during times of economic recovery. When the market hits rock bottom, some of the best investment opportunities become available, and the individuals who are willing to take on some risk and invest in those opportunities can see huge gains. In contrast, those who hold cash and wait for the perfect time to invest often find themselves sitting on the sidelines, watching others capitalize on the opportunities they were too cautious to pursue. The cash paradox also plays out on a global scale. Central banks, which control the money supply in most countries, are aware of the dangers of holding too much cash within an economy. In fact, central banks often attempt to stimulate economic activity by printing more money or lowering interest rates to encourage borrowing and spending. The idea is to create inflation and prevent deflation, which can cause a stagnant economy. However, when inflation runs too high, the purchasing power of money erodes too quickly, making it harder for consumers and businesses to maintain their standard of living. This delicate balance between encouraging economic activity and managing inflation is one of the key challenges faced by central banks, and it underscores the inherent risk in holding large amounts of cash. At the personal level, the cash paradox forces individuals to weigh the benefits of flexibility against the cost of lost purchasing power. Cash gives you the ability to respond quickly to opportunities, whether that's a sale, a new investment, or an emergency. But holding too much cash for too long, especially in the face of rising inflation, means that your wealth will gradually lose value. The longer you hold cash without putting it to work, the greater the erosion of your purchasing power. In an ideal world, it's important to have a balance between holding cash for flexibility and using other assets to preserve and grow your wealth. Cash should be seen as a tool for short-term liquidity, not as a long-term store of value. For individuals who hold significant amounts of cash, it's important to consider how inflation will impact their wealth over time and whether other investments, like stocks, bonds, or real estate, could offer better returns. Holding cash for short periods, during periods of high uncertainty or for specific goals, may be appropriate, but it should not become a long-term strategy. Over time, the purchasing power of your money will erode, and you may miss out on the chance to grow your wealth and preserve its value against inflation. The concept of market efficiency has been a central idea in finance for decades. According to the efficient market hypothesis, EMH, financial markets are informationally efficient, meaning that asset prices fully reflect all available information at any given time. If this theory is true, then it suggests that it is impossible for investors to consistently outperform the market through strategies like stock picking or market timing. Essentially, if markets are truly efficient, there is no advantage in trying to beat the market because all relevant information is already embedded in asset prices. However, this leads to a paradox. While the EMH suggests that it's futile to try to beat the market, people still attempt to do so every day. And remarkably, their actions play a role in keeping the market efficient. This paradox is at the heart of financial markets. People who are trying to outperform the market by identifying mispriced assets or predicting market movements are, in effect, contributing to the very efficiency they are trying to outsmart. The first part of this paradox rests on the assumption that if markets are efficient, it should be nearly impossible for anyone to consistently achieve higher returns than the overall market, particularly after accounting for transaction costs. The EMH assumes that all publicly available information is quickly absorbed into asset prices. This means that if a company announces strong earnings, for example, the price of its stock should immediately adjust to reflect this news. As a result, there should be no opportunity for an investor to buy the stock before the price rises or sell it once the price peaks. In an efficient market, it would be incredibly difficult to find undervalued or overvalued stocks, because all the information needed to determine their true value is already reflected in the prices. But despite this theory, countless investors try to beat the market every day. Fund managers, individual investors, and even algorithms are all in pursuit of a return that exceeds the market average. They try to identify stocks that are underpriced, anticipate future trends, or time their trades to exploit small inefficiencies. These investors engage in activities such as technical analysis, fundamental analysis, or quantitative models to find investment opportunities that they believe are mispriced by the market. This quest for superior returns has one surprising consequence. It makes the market more efficient. When investors try to outsmart the market, they are constantly analyzing information and making decisions based on their perceptions of mispricing. If they find what they believe is an undervalued asset, they will buy it, which increases its demand and pushes its price closer to its true value. Similarly, when investors believe an asset is overvalued, they sell it, which drives its price down. As more investors take this approach, the market's prices adjust more quickly and accurately to reflect all available information, making it harder for anyone to consistently find opportunities for excess returns. This cycle creates a self-fulfilling prophecy. Investors trying to beat the market contribute to the efficiency of the market. The more investors there are trying to outperform the market, the quicker prices adjust to reflect new information. This dynamic helps ensure that no one is able to consistently achieve returns that beat the market on a risk-adjusted basis. As soon as a mispricing is detected and exploited, the opportunity disappears, and prices settle at a level that reflects the available information. The paradox becomes even more pronounced when considering the sheer number of people trying to outperform the market. In theory, if everyone were to adopt the efficient market hypothesis and simply invest in broad market indices, the market would reach perfect efficiency more quickly. However, the reality is that investors continue to believe in the possibility of outperforming the market. Even when faced with the evidence that most active managers struggle to beat the market over time, many still try to do so. This results in a constant cycle of buying and selling, driven by the belief that there are opportunities to exploit. In the end, these efforts create the very market efficiency that makes it so difficult to outperform the market. One of the key implications of this paradox is the difficulty of distinguishing between true inefficiencies in the market and simple fluctuations in asset prices. Many investors believe that by identifying these inefficiencies, whether it's a stock that has been undervalued by the market or an emerging trend, they can gain an edge. However, in an efficient market, what may seem like an inefficiency is often just a temporary fluctuation that reflects new information being absorbed into the market. As a result, investors may be chasing opportunities that don't exist or that quickly vanish once they are identified. The paradox also raises questions about the role of active versus passive investing. Passive investors, who invest in broad market indices rather than trying to pick individual stocks or time the market, rely on the belief that markets are efficient. They assume that by holding a diversified portfolio, they will receive returns that reflect the overall performance of the market, without the need for market timing or stock picking. Passive investing has gained popularity in recent years, especially as evidence mounts that actively managed funds often underperform passive index funds over the long term. However, the presence of active investors who are trying to outperform the market plays a crucial role in maintaining the efficiency of the market. By constantly analyzing and responding to new information, active investors help ensure that prices remain accurate. In a way, active investors are performing a valuable function, even if they are not consistently beating the market. Their collective actions ensure that the market remains competitive and efficient, as they help push prices toward their true value. Yet, despite the important role of active investors, the odds of consistently beating the market are slim. Studies have shown that, over long periods, most active managers fail to outperform a simple index fund. This is due to several factors, including high fees, transaction costs, and the difficulty of predicting market movements with any degree of accuracy. Even fund managers with access to sophisticated tools and research often struggle to deliver superior returns after accounting for costs. The result is that while people may try to beat the market, they often end up merely participating in a system that maintains its own efficiency. The market efficiency paradox also highlights the limitations of human behavior in financial markets. Investors are naturally drawn to the idea of beating the market. It's an alluring proposition, one that promises higher rewards for those who can outsmart the collective wisdom of the market. But this desire often leads to overconfidence and a tendency to underestimate the difficulty of consistently beating the market. As a result, many investors are caught in a cycle of chasing returns and trying to outthink the market, when the reality is that the market is already operating at a high level of efficiency. In the end, the market efficiency paradox illustrates the tension between the belief in market inefficiencies and the reality of market efficiency. While it may seem that inefficiencies exist and that there are opportunities to outperform, the actions of those trying to exploit these opportunities actually contribute to the efficiency of the market. This paradox serves as a reminder that, in financial markets, the pursuit of superior returns often leads to outcomes that are precisely the opposite of what investors hope for: greater efficiency and less room for profit. Diversification is one of the cornerstones of sound investment strategy. The basic idea behind it is simple. By spreading investments across different assets, industries, or geographic regions, you reduce the overall risk. The logic is that if one asset or sector performs poorly, others in the portfolio might perform better, thus balancing the overall risk. In theory, a diversified portfolio should protect an investor from the worst outcomes. Yet, there's a paradox that lies at the heart of this strategy. Diversification reduces risk until everything crashes together. To understand this paradox, it's helpful to start by looking at how diversification works in normal market conditions. Suppose you have a portfolio that includes a mix of stocks, bonds, real estate, and perhaps even some commodities like gold. If one sector, say stocks, takes a hit due to a market correction, the other sectors in your portfolio may not be affected in the same way. Bonds, for example, often perform well when stock markets are down, providing a cushion to your portfolio. Real estate and commodities might follow their own cycles, which could mean they don't move in the same direction as stocks or bonds at all times. This is the protective power of diversification. It spreads the risk across multiple areas, reducing the chances that your entire portfolio will suffer a major loss at once. The more diverse the assets are within a portfolio, the less likely that a downturn in one sector will devastate the entire portfolio. This is the foundation of modern portfolio theory, which suggests that an investor should not put all their eggs in one basket. For instance, if you invested solely in the stock market, you would be highly exposed to the risks inherent in stock prices, volatility, market crashes, or sector-specific downturns. By diversifying into bonds, real estate, and other asset classes, you reduce that exposure and improve the likelihood of a smoother ride in the long term. However, this strategy faces a significant limitation when markets experience systemic shocks. In a normal economic downturn, different sectors may still behave somewhat independently, allowing for some degree of protection. But during more extreme events, such as financial crises or pandemics, even diversified portfolios can take a major hit. When everything crashes together, diversification becomes far less effective. A key example of this paradox was observed during the 2008 global financial crisis. In the lead-up to the crisis, many investors believed that their portfolios were well diversified. They spread their investments across a variety of asset classes, including stocks, bonds, and real estate. However, when the crisis hit, virtually every asset class suffered. Stocks plummeted in value as the market spiraled into chaos. Real estate prices collapsed in many parts of the world as the housing market, which had been a popular asset class, crumbled. Even bonds, which are typically seen as a safe haven during times of stock market volatility, took a hit as credit markets froze and interest rates fell to historic lows. Gold, which traditionally serves as a hedge against economic uncertainty, also saw its price fluctuate erratically in the early months of the crisis. What happened during the 2008 crisis wasn't just a downturn in one or two markets. It was a systemic shock that affected nearly every aspect of the global economy, from financial institutions to commodities to international trade. The financial contagion spread across borders and industries, leaving investors with few places to hide. Diversification, which had seemed like a solid strategy for reducing risk, failed to protect portfolios from the magnitude of the crash. This same pattern can be observed during other large-scale events. The COVID-19 pandemic, for example, was a global event that led to massive economic disruptions. In the early stages of the pandemic, stock markets worldwide took a nosedive. Bonds, typically seen as a safe bet during stock market turbulence, also faltered due to the unprecedented nature of the crisis. Even some alternative assets, such as oil, which was trading at negative prices for the first time in history, were not immune to the shock. Once again, the widespread nature of the crisis meant that even a well-diversified portfolio could experience substantial losses. This brings us to the core of the diversification paradox. It works well in normal times, but when markets experience systemic stress, when everything crashes together, diversification loses its protective power. This paradox is particularly troubling for investors who rely on diversification as the primary strategy to mitigate risk. While it's true that diversification reduces the likelihood of suffering catastrophic losses in typical market cycles, it does not guarantee protection during extraordinary events. The paradox is also complicated by the interconnectedness of global markets. In today's world, economies, businesses, and financial systems are deeply intertwined. A financial shock in one country can quickly spread to others, as we saw during the global financial crisis. A problem in the banking system can have a ripple effect on all asset classes, including stocks, bonds, real estate, and even commodities. Because markets are so interconnected, the idea of a diversified portfolio offering protection from all risks becomes less reliable when these systemic crises unfold. Moreover, diversification can only reduce the risk of specific events, not all types of risk. A well-diversified portfolio may protect an investor from the risk of losing money due to the failure of a single company or sector, but it doesn't protect against systemic risk, the risk that the entire financial system or economy might collapse under the weight of an unexpected crisis. While diversification can guard against many risks, it does not eliminate the risk that everything might decline at the same time. Another complication is that diversification often relies on historical correlations between asset classes. For instance, stocks and bonds typically move in opposite directions. When stocks are down, bonds tend to perform better, and vice versa. This relationship holds during many types of market disruptions, but it may break down during extreme events. In times of heightened uncertainty or panic, investors may sell off assets indiscriminately to raise cash, causing a broad sell-off that impacts everything from stocks to bonds to commodities. In these situations, the relationships between different asset classes break down, leaving diversification less effective. The idea that diversification reduces risk is based on the assumption that asset classes will not always move in sync with one another. However, during crises, correlations between assets can rise dramatically. When this happens, all assets may move in the same direction, down, and diversification cannot protect investors from this simultaneous decline. In this way, the diversification strategy becomes much less reliable when it's needed most. While diversification remains an important risk management tool, the diversification paradox highlights a critical flaw in the strategy. It's not a foolproof way to protect against all types of risk. Diversification is only effective as long as the different assets in a portfolio behave independently of one another. But when everything crashes together, diversification cannot shield investors from the full impact of the crisis. This paradox is a reminder for investors that no strategy is perfect and that diversification, while effective in many situations, cannot eliminate risk entirely. It's essential for investors to understand the limits of diversification and to be prepared for times when the strategy may not provide the protection they expect. During systemic crises, when markets crash together, even the most diversified portfolios can suffer substantial losses. Understanding these limitations is key to navigating the complexities of investment risk. In the world of investing, there is an ongoing debate between value and growth stocks. On one hand, value stocks, those that are priced lower than their intrinsic value and often have a strong track record of profitability, tend to outperform in the long term. On the other hand, growth stocks, which are typically companies expected to grow at an above-average rate compared to their industry or the market as a whole, attract a lot of attention from investors, especially in the short term. Despite historical evidence that value stocks tend to deliver superior long-term returns, investors consistently chase growth stocks, hoping for the next big winner. This behavior creates a paradox. Value stocks are generally the better long-term investment, yet investors continue to pour money into growth stocks. The main reason for the allure of growth stocks is the potential for rapid, substantial gains. Investors are drawn to companies that are expanding quickly, innovating, and capturing significant market share. Growth stocks often come from emerging industries or companies that seem poised to dominate their respective markets. These companies often promise future returns that are far greater than what is currently reflected in their stock price, and that potential for significant upside makes them very appealing to investors. When people see a company like a tech startup or a new drug developer, they envision skyrocketing revenues, increasing market share, and an ever-expanding business. The idea of buying a stock before it grows into a dominant player in the industry is an enticing one. However, the reality is that most growth stocks do not deliver on the promise of explosive growth. Many companies that seem poised for greatness fail to live up to expectations. The market is filled with companies that have high valuations based on speculative future growth, but those valuations are often built on shaky assumptions. When the market eventually realizes that the growth is not coming as quickly or as dramatically as anticipated, stock prices can take a significant hit. In contrast, value stocks, which are priced below their intrinsic value and often have a history of profitability, tend to provide more stable returns over the long run. They may not have the same explosive growth potential as high-flying tech stocks, but they often offer steady dividends, solid financial performance, and lower risk, which lead to solid returns over time. Despite this, investors are often reluctant to invest in value stocks because they don't seem as exciting. Value stocks tend to be more established companies, often in mature industries, that aren't seen as cutting-edge or poised for rapid growth. They may not be the subject of the latest trends or headlines, and they certainly don't have the same level of media hype as growth stocks. Value stocks often trade at lower price-to-earnings ratios, and many of them have slower growth prospects. While they may offer solid returns over time, their performance often comes in the form of incremental, rather than dramatic, gains. This makes them less attractive to investors who are seeking excitement or the next big winner. Growth stocks, by contrast, often carry high valuations, sometimes based on nothing more than potential. The market places a premium on companies that are expected to grow quickly, which can result in inflated stock prices. This is especially true during market booms, when investor sentiment can push prices to unsustainable levels. The dot-com bubble of the late 1990s is a perfect example of how growth stocks can become overvalued. During that time, investors poured money into technology companies, betting that the internet and other new technologies would change the world. Many of these companies were overhyped and lacked solid financial fundamentals. When the bubble burst, many of these growth stocks collapsed, leaving investors with significant losses. Yet, even in the wake of the dot-com crash and other instances where growth stocks have underperformed, investors continue to chase the next big growth story. One reason for this is the fear of missing out, FOMO. When investors see the success stories of companies like Amazon, Tesla, or Apple, they want to get in early before the next company experiences massive growth. The allure of getting in on the ground floor can be incredibly powerful, especially when investors see others making significant profits. The success of these companies creates a narrative that growth stocks are the way to go, and this narrative persists even in the face of historical evidence suggesting that value investing tends to provide better returns in the long run. The value growth paradox is further complicated by the fact that growth stocks often outperform value stocks during periods of strong economic expansion. When the economy is growing rapidly, companies in emerging industries, particularly technology, can experience rapid gains. Investors in growth stocks can see substantial returns when these companies hit their growth targets. However, when the economy slows down or enters a recession, growth stocks tend to suffer more than value stocks. Growth companies are often dependent on future earnings, and when growth slows or expectations fall short, their stock prices can plummet. Value stocks, on the other hand, tend to be more stable as they are already priced lower and have established revenue streams. In the long term, value investing tends to deliver superior returns, especially when considering risk-adjusted returns. Value stocks often outperform growth stocks over extended periods because they are typically priced more conservatively, making them less volatile. Additionally, value stocks tend to offer higher dividend yields, which can be an important source of return over time. Dividend payments provide investors with a steady stream of income, which can compound over time and add to overall returns. Growth stocks, by contrast, often do not pay dividends, as they reinvest their earnings to fund expansion, leaving investors with no immediate cash flow from their investments. Despite these advantages, the appeal of growth stocks remains strong. Part of the reason for this is that growth stocks are often more exciting, and excitement can drive investor behavior. There is a psychological element to investing in growth stocks, where investors are willing to pay a premium for the possibility of future rewards. Value stocks, on the other hand, are often viewed as less exciting or boring, which makes them less attractive to many investors. The desire for excitement, combined with the potential for large returns, makes growth stocks seem more appealing, even though they tend to underperform value stocks over the long term. The media and the financial industry also play a role in perpetuating the value growth paradox. News outlets often focus on the latest hot growth stocks, hyping up the companies that are expected to revolutionize industries. Analysts and fund managers are often drawn to growth stories because they can be more exciting to write about or talk about in front of clients. This emphasis on growth can create a cycle where investors are constantly chasing the next big opportunity, rather than focusing on the more reliable, steady returns offered by value stocks. One of the most interesting aspects of the value growth paradox is that it persists even in the face of evidence showing that value stocks outperform in the long run. Over time, value investing has consistently been shown to generate superior returns compared to growth investing, especially when adjusted for risk. Numerous studies have demonstrated that value stocks tend to deliver better performance over extended periods. However, the desire for high returns, the psychological appeal of growth, and the media's focus on exciting growth stories continue to drive investors toward growth stocks, even when they are aware of the long-term benefits of value investing. In the end, the value growth paradox highlights a fundamental truth about human behavior in investing. People are often driven by emotion, excitement, and short-term thinking, even when long-term evidence suggests a different course of action. Value stocks, which tend to outperform over time, are often overlooked in favor of growth stocks, which provide the allure of high returns and excitement. Yet, despite this, value investing continues to prove its worth, as it offers a more stable, reliable, and rewarding path for those willing to take a longer-term view. Inflation is a persistent force that erodes the purchasing power of money over time. As the cost of goods and services rises, each dollar you hold today buys less tomorrow. To counter this, many investors turn to assets like gold and real estate, which are widely considered to be inflation hedges. The logic is simple. When inflation rises, the value of these assets will increase, preserving the purchasing power of your wealth. However, the relationship between inflation and the performance of these assets is not always straightforward. Sometimes, these so-called inflation hedges fail to live up to their reputation, creating what can be called the inflation hedge paradox. Gold has long been viewed as a safe haven during times of inflation. As the price of goods and services rises, people often buy gold because it has traditionally maintained its value. This is especially true during periods of high inflation or economic uncertainty. The idea is that, unlike paper money, which can be printed in unlimited quantities, gold is a finite resource, making it immune to the devaluation that affects currencies. In theory, when inflation rises, the value of gold should rise along with it, as more people seek to preserve their wealth. Yet, there are times when gold fails to act as an effective hedge against inflation. During periods of deflation or low inflation, gold prices can stagnate or even decline. This is because gold's price is not just influenced by inflation, but also by a range of other factors, including interest rates, currency strength, and global economic conditions. For example, when interest rates are high, investors may choose to move their money into bonds or other fixed-income investments that provide better returns. This shift in investor behavior can reduce demand for gold, causing its price to drop despite rising inflation. Similarly, if the dollar is strong, it can offset inflationary pressures, making gold less attractive. The 1970s are often cited as an example of gold acting as a strong inflation hedge. During this period, inflation in the US soared, and the price of gold skyrocketed, peaking at over $800 per ounce by the end of the decade. In this case, gold performed as expected, rising in value as inflation took hold. However, the situation in the 2000s presents a different story. In the aftermath of the 2008 financial crisis, gold's price initially surged as investors sought a safe haven from the economic instability. Yet, during the subsequent periods of low inflation, the price of gold leveled off or even declined, failing to provide the same protective benefits it had in the past. Real estate is another asset that is often seen as an inflation hedge. Like gold, real estate has a long history of maintaining its value during inflationary periods. The theory is that as the cost of living rises, so too does the cost of housing. Additionally, real estate can provide rental income, which may increase in value along with rising prices. The physical nature of real estate, combined with its potential for appreciation, makes it an appealing choice for those looking to protect their wealth from inflation. However, real estate does not always respond to inflation in the way that many expect. While property values may increase in line with inflation, they can also be affected by a variety of other factors, such as interest rates, supply and demand dynamics, and government policy. For example, during periods of rising interest rates, the cost of borrowing increases, which can reduce demand for housing and lead to a decline in property values. This was evident during the housing crisis of 2008, when real estate prices plummeted despite inflationary pressures in other parts of the economy. In this case, the rapid increase in housing prices leading up to the crisis was driven more by speculative behavior and easy credit than by inflation. When the market corrected, real estate prices fell sharply, leaving many investors with significant losses. In addition, real estate is a less liquid asset compared to gold or stocks. This means that it may not be as easily tradable or convertible into cash during periods of economic uncertainty. For example, during the early stages of the COVID-19 pandemic, real estate markets in many parts of the world experienced a sharp decline as buyers and sellers withdrew from the market. In some cases, property prices stagnated or fell, even as inflationary pressures were mounting in other sectors of the economy. This showed that real estate could fail to serve as an inflation hedge during times of market dislocation, despite its traditional role as a safe investment. The inflation hedge paradox also extends to the broader concept of what constitutes an inflation hedge. Investors often look for assets that are positively correlated with inflation, assuming that these assets will protect them from its damaging effects. However, there are times when inflation can actually harm these assets. For example, if inflation rises too quickly, it can lead to higher interest rates as central banks try to control inflation. Rising interest rates can hurt the performance of both gold and real estate, as higher borrowing costs reduce demand for both assets. Gold may lose its appeal as an investment, while real estate values can suffer from higher mortgage rates, making homes less affordable. The paradox is also evident when considering the potential for inflation to lead to economic slowdowns. High inflation can erode consumer purchasing power, reducing demand for goods and services. This can lead to lower economic growth, which in turn can reduce the value of assets like real estate or stocks. In this scenario, the very inflation that was supposed to increase the value of these assets instead leads to a slowdown in economic activity, causing asset prices to fall. This situation can leave investors wondering how inflation, which they expected to boost their wealth, has instead contributed to a decline in the value of their investments. Furthermore, inflation is often unpredictable, and its effects can vary depending on the underlying economic conditions. A sudden surge in inflation might lead to a brief increase in the value of gold or real estate, but this may not last if inflation expectations are not sustained or if the economy enters a recession. The relationship between inflation and asset prices is not linear, and there is no guarantee that an inflationary environment will automatically result in higher returns for these traditional inflation hedges. In fact, there are times when inflation can cause more harm than good, as it distorts market expectations and creates uncertainty about the future direction of prices. The inflation hedge paradox challenges the assumption that assets like gold and real estate will always perform well during inflationary periods. While they have historically provided a measure of protection against rising prices, there are times when they fail to do so. This is because inflation does not act in isolation. It is influenced by a wide range of factors, including interest rates, economic growth, and investor behavior. When these factors align in unexpected ways, the protective benefits of gold, real estate, or other traditional inflation hedges can be muted or even reversed. Investors need to be aware of the limitations of these inflation hedges and consider other strategies for protecting their wealth in times of rising inflation. While gold and real estate may still play a role in an inflation-proof portfolio, relying solely on them can expose investors to unexpected risks. The inflation hedge paradox underscores the importance of diversification and understanding the complex relationship between inflation and different asset classes. Volatility is a term often used to describe the fluctuations in the price of an asset, a market, or an entire economy. In finance, it is often seen as a measure of risk, and the general belief is that high volatility means high risk. This understanding shapes how investors approach the market. When volatility is high, they may act more cautiously, while low volatility often encourages more risk-taking. The volatility paradox comes into play when we observe that periods of low volatility are frequently followed by sudden spikes in volatility. In other words, when things seem calm and stable today, there is often an underlying risk that things may become much more volatile tomorrow. The paradox can be explained through the dynamics of market behavior. When volatility is low, the market often seems stable. Prices of stocks, bonds, or other financial assets fluctuate within a narrow range, and there is a general sense that the market is in a normal or healthy state. During these times, investors may feel more comfortable, taking on riskier investments or maintaining positions they might otherwise avoid. This behavior can lead to higher levels of borrowing and speculation. Investors may feel encouraged to push the market higher, buying more assets or taking out loans with the expectation that the market will continue to rise steadily. In the short term, low volatility often fosters a sense of security and confidence. However, this sense of calm can be deceptive. The reality is that volatility is cyclical and often follows patterns. When there is a prolonged period of low volatility, it can set the stage for a dramatic reversal in the future. Low volatility typically means that there is little new information or disruption in the market to cause significant price movements. But this stability often builds up underlying risks that have not yet been fully accounted for. Eventually, something happens. A new piece of economic data is released, a geopolitical crisis erupts, or a sudden market event takes place that disrupts the status quo and triggers a sharp increase in volatility. One way to think about this paradox is by imagining the market as a pressure cooker. For a long time, the market can experience a stable or quiet period with relatively little change in asset prices. But under the surface, there are pressures building up. Investors may take on more risk, economic conditions may shift, or global events could begin to create uncertainty. As these forces accumulate, they build tension in the system. When this pressure is finally released, It often results in a sharp increase in volatility as investors scramble to adjust to new realities, making large moves in a short period of time. A prime example of this paradox can be seen in the behavior of financial markets prior to the 2008 financial crisis. Leading up to the crash, there was a period of relatively low volatility in the markets. Asset prices, particularly in the housing market, were rising steadily, and there was a general sense of optimism. Investors were confident, banks were lending freely, and there seemed to be little reason to worry. The markets appeared stable, but underlying risks were building up. The housing market had become increasingly inflated, and risky financial instruments, like mortgage-backed securities, were being traded freely with little concern for the potential consequences. As these risks grew, the sudden shock of the housing market collapse triggered massive volatility in the financial markets. The low volatility of the years leading up to the crisis made the eventual market swings even more dramatic and destructive. Another example of the volatility paradox is found in the periods of calm that often follow large market downturns. After a significant market crash or financial crisis, markets tend to stabilize and volatility decreases for a time. This stability can lull investors into a false sense of security, leading them to believe that the worst is behind them. However, this period of low volatility can be a dangerous time for complacency. Investors may become overconfident, re-enter the market with greater risk, or underestimate the potential for another shock. The calm period that follows a crash is often the eye of the storm, with a sudden spike in volatility just around the corner. A perfect example of this occurred after the dot-com bubble burst in the early 2000s. In the years following the crash, markets saw periods of relative stability. But in 2007 to 2008, the global economy faced another crisis that brought volatility back to the forefront, in a way that many investors were unprepared for. The relationship between low volatility today and high volatility tomorrow is driven by the way markets process information. When there is little price movement, investors may assume that the market is efficient and that all relevant information is already reflected in asset prices. This leads to fewer market-moving events and a period of calm. But when new information is introduced, especially if it contradicts the existing assumptions about the economy or the market, it can trigger rapid reactions. Investors, realizing they were too complacent, may start to react all at once, leading to sharp movements in prices. This is why volatility tends to be cyclical. Periods of stability are followed by periods of disruption as new information challenges the previously held view of the market. It's also important to note that the volatility paradox is not limited to financial markets. In economies and industries, periods of stability often precede periods of disruption. When things seem to be going smoothly, businesses may become complacent, not anticipating changes in consumer behavior, technological advancements, or regulatory changes that could disrupt their industries. Take, for example, the tech sector. After periods of rapid growth and low volatility, unexpected technological breakthroughs or changes in consumer demand can suddenly shift the landscape, leading to massive volatility in stock prices. Companies that once seemed to be in stable positions can quickly find themselves facing a sudden crisis. In the investment world, understanding the volatility paradox is key to managing risk. Investors who ignore this cycle may become overly confident during periods of low volatility, thinking the good times will continue indefinitely. They might increase their exposure to high-risk assets, expecting a stable return. But when the volatility finally spikes, they may find themselves facing significant losses. Conversely, investors who are aware of the paradox may be more cautious during periods of low volatility, recognizing that these times are often the calm before the storm. They might take steps to protect their portfolios, such as diversifying their investments or hedging against potential risks. The volatility paradox also highlights the need for long-term thinking. Many investors focus on short-term fluctuations in the market, reacting to daily movements and trying to time their investments for maximum profit. However, those who take a more long-term approach tend to weather volatility better. By staying diversified and resisting the temptation to make drastic moves in response to short-term market shifts, investors can avoid the emotional reaction that often accompanies high volatility. The key is understanding that volatility is part of the natural market cycle, and periods of calm are not necessarily signs that the risk has disappeared. In the end, The volatility paradox underscores the inherent unpredictability of financial markets. Just as low volatility can lead to complacency, high volatility can be an opportunity for those who are prepared. By recognizing the cyclical nature of volatility and understanding that low volatility often leads to higher volatility down the road, investors can take a more strategic approach to managing risk and protecting their portfolios. Volatility is a term often used to describe the fluctuations in the price of an asset, a market, or an entire economy. In finance, it is often seen as a measure of risk, and the general belief is that high volatility means high risk. This understanding shapes how investors approach the market. When volatility is high, they may act more cautiously, while low volatility often encourages more risk-taking. The volatility paradox comes into play when we observe that periods of low volatility are frequently followed by sudden spikes in volatility. In other words, when things seem calm and stable today, there is often an underlying risk that things may become much more volatile tomorrow. The paradox can be explained through the dynamics of market behavior. When volatility is low, the market often seems stable. Prices of stocks, bonds, or other financial assets fluctuate within a narrow range, and there is a general sense that the market is in a normal or healthy state. During these times, investors may feel more comfortable, taking on riskier investments or maintaining positions they might otherwise avoid. This behavior can lead to higher levels of borrowing and speculation. Investors may feel encouraged to push the market higher, buying more assets or taking out loans with the expectation that the market will continue to rise steadily. In the short term, low volatility often fosters a sense of security and confidence. However, this sense of calm can be deceptive. The reality is that volatility is cyclical and often follows patterns. When there is a prolonged period of low volatility, it can set the stage for a dramatic reversal in the future. Low volatility typically means that there is little new information or disruption in the market to cause significant price movements. But this stability often builds up underlying risks that have not yet been fully accounted for. Eventually, something happens. A new piece of economic data is released, a geopolitical crisis erupts, or a sudden market event takes place that disrupts the status quo and triggers a sharp increase in volatility. One way to think about this paradox is by imagining the market as a pressure cooker. For a long time, the market can experience a stable or quiet period with relatively little change in asset prices. But under the surface, there are pressures building up. Investors may take on more risk, economic conditions may shift, or global events could begin to create uncertainty. As these forces accumulate, they build tension in the system. When this pressure is finally released, it often results in a sharp increase in volatility, as investors scramble to adjust to new realities, making large moves in a short period of time. A prime example of this paradox can be seen in the behavior of financial markets prior to the 2008 financial crisis. Leading up to the crash, there was a period of relatively low volatility in the markets. Asset prices, particularly in the housing market, were rising steadily, and there was a general sense of optimism. Investors were confident, banks were lending freely, and there seemed to be little reason to worry. The markets appeared stable, but underlying risks were building up. The housing market had become increasingly inflated, and risky financial instruments, like mortgage-backed securities, were being traded freely with little concern for the potential consequences. As these risks grew, the sudden shock of the housing market collapse triggered massive volatility in the financial markets. The low volatility of the years leading up to the crisis made the eventual market swings even more dramatic and destructive. Another example of the volatility paradox is found in the periods of calm that often follow large market downturns. After a significant market crash or financial crisis, markets tend to stabilize and volatility decreases for a time. This stability can lull investors into a false sense of security, leading them to believe that the worst is behind them. However, this period of low volatility can be a dangerous time for complacency. Investors may become overconfident, re-enter the market with greater risk, or underestimate the potential for another shock. The calm period that follows a crash is often the eye of the storm, with a sudden spike in volatility just around the corner. A perfect example of this occurred after the dot-com bubble burst in the early 2000s. In the years following the crash, markets saw periods of relative stability. But in 2007 to 2008, the global economy faced another crisis that brought volatility back to the forefront, in a way that many investors were unprepared for. The relationship between low volatility today and high volatility tomorrow is driven by the way markets process information. When there is little price movement, investors may assume that the market is efficient and that all relevant information is already reflected in asset prices. This leads to fewer market-moving events and a period of calm. But when new information is introduced, especially if it contradicts the existing assumptions about the economy or the market, it can trigger rapid reactions. Investors, realizing they were too complacent, may start to react all at once, leading to sharp movements in prices. This is why volatility tends to be cyclical. Periods of stability are followed by periods of disruption as new information challenges the previously held view of the market. It's also important to note that the volatility paradox is not limited to financial markets. In economies and industries, periods of stability often precede periods of disruption. When things seem to be going smoothly, businesses may become complacent, not anticipating changes in consumer behavior, technological advancements, or regulatory changes that could disrupt their industries. Take, for example, the tech sector. After periods of rapid growth and low volatility, unexpected technological breakthroughs or changes in consumer demand can suddenly shift the landscape, leading to massive volatility in stock prices. Companies that once seemed to be in stable positions can quickly find themselves facing a sudden crisis. In the investment world, understanding the volatility paradox is key to managing risk. Investors who ignore this cycle may become overly confident during periods of low volatility, thinking the good times will continue indefinitely. They might increase their exposure to high-risk assets, expecting a stable return. But when the volatility finally spikes, they may find themselves facing significant losses. Conversely, investors who are aware of the paradox may be more cautious during periods of low volatility, recognizing that these times are often the calm before the storm. They might take steps to protect their portfolios, such as diversifying their investments or hedging against potential risks. The volatility paradox also highlights the need for long-term thinking. Many investors focus on short-term fluctuations in the market, reacting to daily movements and trying to time their investments for maximum profit. However, those who take a more long-term approach tend to weather volatility better. By staying diversified and resisting the temptation to make drastic moves in response to short-term market shifts, investors can avoid the emotional reaction that often accompanies high volatility. The key is understanding that volatility is part of the natural market cycle, and periods of calm are not necessarily signs that the risk has disappeared. In the end, the volatility paradox underscores the inherent unpredictability of financial markets. Just as low volatility can lead to complacency, high volatility can be an opportunity for those who are prepared. By recognizing the cyclical nature of volatility and understanding that low volatility often leads to higher volatility down the road, investors can take a more strategic approach to managing risk and protecting their portfolios. Simple investing strategies work. They're backed by data, easy to understand, and often outperform complex ones over time. Buy a low-cost index fund, reinvest the dividends, hold it for decades, avoid market timing, stay diversified. That approach beats most active funds. It beats most stock pickers. It beats most traders. And it's not even close. But most investors don't stick with it. They chase complexity instead. They look for secret formulas, algorithms, expert insight, or market predictions. They ignore the simple plan in favor of something that feels more intelligent. That's the simplicity paradox. Simple strategies win, but people crave complexity. It starts with a basic human instinct. People equate complexity with sophistication. A model with more variables must be smarter. A portfolio with more holdings must be better diversified. A strategy that uses advanced math must be safer. In everyday life, complexity often signals expertise. A detailed diagnosis from a doctor sounds more convincing than a simple one. A long explanation from a lawyer seems more authoritative. The same instinct shows up in finance. Investors want to believe that something complicated must offer an edge. But financial markets don't reward complexity the way people expect. Markets are noisy, adaptive, and influenced by behavior. They punish overconfidence. The more moving parts a strategy has, the more things can go wrong. Timing must be perfect. Assumptions must hold. Inputs must stay relevant. And when the market changes, as it always does, the complex model may no longer fit. Meanwhile, the simple strategy keeps working. It doesn't try to predict. It just participates. Consider dollar-cost averaging. You invest the same amount of money at regular intervals, regardless of market conditions. This method doesn't try to buy low or sell high. It buys through highs and lows. It averages out volatility. Over time, it builds wealth. It doesn't require forecasting, technical analysis, or deep research, and it outperforms many more sophisticated strategies that rely on timing the market. Yet it's often dismissed as too basic, too boring. The same applies to index investing. Buying a total market fund or an S&P 500 fund gives you exposure to hundreds of companies. Costs almost nothing. It requires no monitoring, no rebalancing, no insider knowledge. Decades of research show that passive index funds outperform the majority of actively managed funds, especially after fees. But investors still pour money into high-fee funds and hedge funds. They assume complexity means control. It doesn't. It just means more things can break. Active management isn't just more complex, it also plays on ego. It lets people believe they're in control, that they can spot trends before others, that their insight adds value. And sometimes it does, but consistently beating the market is rare. It requires skill, discipline, and luck. Most investors, retail and professional, underperform over time, but they keep trying. Complexity gives the illusion of power. Even outside of asset management, the desire for complex answers misleads. In financial planning, people seek custom strategies, exotic insurance products, and tax structures that sound advanced. But the best advice is often the simplest. Spend less than you earn. Save early. Stay insured. Avoid debt. Invest steadily. Don't panic. That plan works. But it sounds too plain. So people look elsewhere. They hire expensive advisors. They pay for seminars. They chase systems with more steps. And they often end up worse off. Part of the problem is boredom. Simple strategies don't change much. They don't give people something to do. Investors want to feel involved. They want to tweak, adjust, and optimize. They follow the news. They check markets. They make small trades. But every action carries risk. Each decision is a chance to get it wrong. Simple strategies avoid that trap by design. They succeed not by precision, but by consistency. There's also social pressure. Simplicity doesn't impress. Saying, "I own an index fund," doesn't spark interest. Saying, "I'm long emerging markets with a covered call overlay and tail risk hedge," makes people listen, even if the strategy underperforms. Complexity sounds smart. Simplicity sounds lazy. So people dress up their approach. They add layers. They create narratives. They make investing harder than it needs to be. Professionals are vulnerable too. Advisors, analysts, and portfolio managers need to justify their existence. If they recommend a plain index fund and do nothing, clients may question the fee. So they complicate. They add asset classes. They recommend alternative investments. They rebalance more often. They forecast interest rates or market cycles. It creates the appearance of value, even when the results lag behind a simpler benchmark. The simplicity paradox also shows up in backtesting. Many strategies look brilliant in hindsight. They use historical data to build complex rules. Buy when this crosses that, sell when this ratio hits a certain level, rotate sectors quarterly, and so on. The result is a clean chart with high returns. But these strategies often fail in real time. They're overfit. They captured past patterns that no longer apply. The complexity wasn't insight, it was data mining. In contrast, simple rules endure. A 60-40 stock bond portfolio, a target date retirement fund, a regular savings habit. These don't promise to beat the market, but they keep investors in the game. They prevent catastrophic mistakes, and they often outperform the complex strategies that react to every signal. Simplicity trades the hope of outperformance for the reality of staying invested. That trade usually wins. Some of the most successful investors understand this. Warren Buffett recommends index funds for most people. Jack Bogle built Vanguard on the idea that low-cost simplicity beats high-cost complexity. Even Ray Dalio, known for his detailed macro models, emphasizes timeless principles like diversification and discipline. The best in the field don't chase complexity for its own sake. They use it sparingly and only when it adds actual value. Behavioral finance explains part of the paradox. Humans suffer from overconfidence. They think they can do better than the average. They seek patterns where none exist. They believe more information leads to better outcomes. But in investing, more data often leads to more noise. Simpler strategies avoid this trap. They reduce the number of decisions. They remove emotion, and that discipline adds more value than most complex analysis. The problem is that simplicity doesn't sell. It doesn't headline books. It doesn't attract assets. Complexity feels exciting. It gives people a reason to act. And the financial industry is built around giving people something to buy, something to trade, something to believe in. But most of it doesn't work. The simple path is the one most people avoid, even as it passes them by. That's the paradox. The strategy that wins is the one people overlook because it looks too easy. Markets are built on the idea that people make rational decisions. Every buyer and seller is supposed to weigh the facts, consider the risks, and act in a way that maximizes value. This is the core assumption of many financial models. Prices reflect all available information. Supply meets demand. Investors act logically. But anyone who's watched markets in real time knows that this isn't how things actually work. Prices swing wildly. People chase trends. Bubbles form and burst. The rational market paradox is this: markets are supposed to be driven by reason, but they often behave like emotional crowds. The theory of rational markets assumes that investors act on clear logic. If a company's profits go up, its stock price should go up. If bad news comes out, prices should drop. But the real world rarely follows such clean lines. What actually moves markets is a blend of data and emotion. Fear, greed, and the fear of missing out, FOMO, are just as powerful as earnings reports and interest rate decisions. During a panic, rational thought often disappears. Investors rush to sell not because the fundamentals have changed, but because they're afraid others will sell first. Fear becomes the driving force. Prices drop not gradually, but in sharp, cascading waves. The 2020 COVID crash is a clear example. In a matter of days, markets lost trillions in value. Many investors weren't responding to a deep economic analysis. They were reacting to headlines, uncertainty, and the instinct to get out before things got worse. Rational market theory doesn't explain that kind of mass behavior. On the other side of fear is greed. When markets are rising, people often abandon caution. Instead of asking whether an asset is overvalued, they ask how much more it can rise. They jump in not because of deep research, but because they see others making money. This behavior fuels bubbles. In the late 1990s, tech stocks soared even when many of the companies had no profits and no clear path to sustainability. People bought in because prices kept rising and others were getting rich. The logic was circular. The stock is going up, so it must be worth buying. When the bubble burst, rational explanations caught up with emotional decisions, and prices came crashing down. FOMO is a more subtle but equally irrational force. It doesn't come from fear or greed directly, but from the discomfort of being left behind. It's what drives someone to buy a stock at its peak because their friends have doubled their money. It's what makes investors chase trends in cryptocurrencies or meme stocks even when they know the fundamentals don't support the price. FOMO isn't about analysis. It's about envy, anxiety, and the desire to not be the one who missed the opportunity. These emotions don't just affect individual investors. Professionals, too, are subject to the same pressures. Fund managers are judged by performance. If they lag behind the market, clients may pull their money. This creates pressure to conform. When certain stocks or sectors are rising fast, even cautious managers feel the need to buy in, not because it's the right call based on fundamentals, but because they can't afford to miss the rally. In this way, rational market actors are pulled into irrational behavior by the structure of the market itself. One of the clearest examples of this paradox came in the 2021 GameStop saga. Retail investors on Reddit banded together to drive up the price of a struggling company's stock, in part to squeeze short sellers. The stock surged to levels far beyond anything the company's performance could justify. Some investors joined in to fight hedge funds. Others joined because the stock was going up. The fundamentals were irrelevant. It was a pure expression of collective sentiment, tribal identity, and momentum. Traditional models could not explain the price. It wasn't about discounted cash flows. It was about internet-fueled excitement and group dynamics. Market reactions to news also highlight the disconnect between rational expectations and actual behavior. A company might report solid earnings, and its stock still drops because the results didn't meet inflated expectations. Or a company might announce a layoff and the stock goes up because investors think it means lower costs in the future. These responses don't always align with simple logic. They're filtered through narratives, biases, and what investors think other investors will do. Behavioral economics has spent decades cataloging the ways people deviate from rationality. We anchor on past prices. We overreact to new information. We fear losses more than we value equivalent gains. We seek confirmation of our beliefs and ignore evidence that contradicts them. All of these traits feed into market behavior. When individuals with these biases make decisions in aggregate, the market reflects those biases, not just raw information. This collective irrationality is what drives markets away from the neat predictions of rational models. Algorithmic trading hasn't removed these human tendencies. In fact, in some ways it amplifies them. Algorithms often follow rules based on past price movements or volatility thresholds. When markets start to move, these systems can accelerate the trend, buying or selling in response to momentum. This creates feedback loops. Small shifts turn into big moves, not because of new information, but because the systems designed to react quickly all react at once. Humans built the algorithms, and they still reflect human logic, sometimes flawed, sometimes brilliant, always limited. The idea that markets are rational is a useful simplification. It allows economists to build models and make predictions. But those models often fail at the exact moments they're most needed, during crashes, bubbles, or major shifts in sentiment. The rational market paradox reminds us that while prices may reflect information, they also reflect emotion. They reflect how people feel about information and how they expect others to feel. If markets were purely rational, there would be no bubbles or crashes, just smooth adjustments to new information. But history is full of irrational booms and devastating collapses. From the Dutch tulip mania to the South Sea bubble, from the Roaring Twenties to the housing crash, the pattern repeats. People believe the good times will last forever. They ignore warning signs. They follow the crowd. And then the bottom falls out. The belief in rational markets also feeds risky behavior. If markets are always efficient, then prices must always be right. This can encourage a kind of passive complacency. Investors might assume there's no point in questioning valuations or challenging the consensus. But when markets become driven more by mood than math, that assumption can be dangerous. The truth is that markets are not machines. They are crowds. Crowds of people with different goals, different levels of understanding, and different emotional triggers. Some are careful. Some are impulsive. Some are thinking long-term. Others are chasing the next quick gain. All of these behaviors collide in the marketplace. The price that results is not just a summary of all available data. It's also a snapshot of the crowd's collective mood at that moment. The rational market paradox doesn't mean we should throw out logic or ignore data. But it does mean we have to understand how real people behave. It means knowing that even the best information can be overwhelmed by fear or hype. It means recognizing that what looks like a rational market from a distance is often a chaotic mix of reason and emotion up close. Passive investing has become one of the most popular approaches to building wealth. It's simple, low cost, and backed by decades of data showing that it often outperforms active investing over long periods. Instead of trying to pick individual stocks or time the market, Passive investors buy broad market indexes like the S&P 500 or total market funds and hold them over time. These indexes capture the overall performance of large swaths of the economy. Investors avoid high fees, limit trading, and benefit from the long-term growth of the market. It seems like a perfect solution, but there's a catch. Passive investing depends entirely on the actions of active investors to work. This is the heart of the paradox. Passive investing beats active investing in the long run, but only because active investors are still doing the hard work of pricing stocks. To understand this paradox, you have to know how passive investing actually works. An index fund doesn't try to judge whether one company is a better investment than another. It simply buys stocks in the proportions dictated by the index. If the S&P 500 includes Apple at 6% and Microsoft at 5%, then the fund buys Apple and Microsoft in those proportions. The prices of those stocks aren't evaluated by the fund manager, they're just accepted. That's the point of passive investing. Accept the market as it is. But the market isn't a static thing. Prices don't exist in a vacuum. They're constantly changing as new information emerges. A company beats earnings expectations, its stock rises. A CEO resigns under scandal, the stock drops. These movements don't come from passive funds. They come from active investors, analysts, hedge funds, institutions, and individual traders who study the company, make a judgment, and place a trade. These active investors are the ones determining what a stock is worth. They are the price setters. Without active investors, there would be no mechanism to adjust prices in response to new information. The market would become inefficient. Bad companies could stay overvalued. Good companies could remain underpriced. Passive investing assumes that prices are already correct, that the market has incorporated all available information. But it's active investors who make that true. When they buy or sell based on information, they move prices. Their actions keep the market efficient. Passive investors, by definition, are just along for the ride. This creates a strange relationship. Passive investors rely on the work of active investors to keep markets functioning. If everyone went passive, the market would lose its ability to process information. Prices would no longer reflect company fundamentals. The very thing that makes passive investing successful, the belief that prices are accurate, would fall apart. This is what makes the passive strategy both powerful and fragile. It works well, but only because others are still doing the work it avoids. Consider what happens when a new company goes public. Active investors analyze the company, determine what it's worth, and decide whether to buy in at the IPO price. They compare it to competitors, study its financials, and form a view of its potential. Passive investors don't participate until the company is added to an index. By that point, its price has already been shaped by the decisions of active investors. The passive investor simply accepts the outcome. This relationship becomes even clearer during major market events. When a crisis hits, a recession, a pandemic, a geopolitical shock, active investors react to the new information. They reassess risk, sell off overvalued assets, and buy those they believe are now undervalued. Their trades adjust prices, helping the market find a new balance. Passive funds don't do this. They continue to hold their positions regardless of what's happening in the world. They don't react, they reflect. The paradox deepens when you consider how much passive investing has grown. Decades ago, passive investing was a fringe idea. Most people used mutual funds managed by professionals trying to beat the market. But as research showed that most active managers failed to outperform over time, investors began shifting to index funds. Today, passive strategies control more than half of US equity assets. That trend continues to grow, and with it, the question becomes louder. What happens if active investors become too few to keep markets efficient? There is no clear answer. In theory, as active investors become rarer, their influence should grow. With fewer people setting prices, those who do will find more opportunities for profit. That could encourage more people to become active again, restoring the balance. In this way, the market might find an equilibrium between active and passive. But it also means that the benefits of passive investing are not permanent or guaranteed. They depend on a functioning market that remains efficient. and that efficiency depends on people actively working to discover prices. The passive investing model also creates second-order effects. Since index funds buy based on size, not merit, the largest companies attract the most investment. When more money flows into an index, the biggest stocks get more buying pressure, which pushes their prices up. This can lead to a form of momentum that's unrelated to fundamentals. Companies grow in value simply because they are large, not because they're better investments. This creates a feedback loop. If unchecked, it can distort the market, driving prices higher in a way that doesn't reflect underlying reality. In a fully rational market, price distortions like this would be corrected by active investors who see the imbalance and bet against it. But if there are too few active participants, that correction might not come. Passive investing, left to itself, could misallocate capital. It could reward companies not for their performance or efficiency, but simply for their presence in an index. Another issue is that passive investors don't provide corporate oversight. Shareholders play a role in governance. They vote on boards, influence policy, and hold management accountable. Active investors take this role seriously. They engage with companies, demand transparency, and push for changes when needed. Passive funds often don't. They vote, but they don't analyze the company's actions in depth. As more of the market shifts to passive ownership, fewer shareholders are watching closely. This reduces the pressure on companies to perform well or act responsibly. Yet, despite these risks, passive investing continues to dominate. It's cheaper, it's simpler, and for most people it works. The average investor is better off buying a broad market index and holding it than trying to outsmart the market. Study after study shows that over long periods, passive strategies outperform the majority of active ones. The fees are lower, the turnover is minimal, and the returns are consistent with market performance. But those results depend on something that passive investors often overlook: the work of others. The passive investor benefits from prices that have been carefully negotiated by people who do the hard work of studying businesses, judging value, and placing bets. The success of passive investing comes not from its own effort, but from the effort of active participants who make the market function. That's the paradox. Passive wins, but only because active is still in the game. When markets move, people don't move alone. They follow each other. They buy what others buy. They sell when others sell. They read headlines, glance at charts, and listen to what their peers are doing. Herd behavior is not just common in markets, it's instinctual. In uncertain environments, doing what the crowd does feels like the safe choice. If everyone else is buying a stock, maybe it's going up. If everyone is selling, maybe they know something you don't. Following the herd can feel like self-preservation. But in financial markets, what feels safe often creates the greatest risk. The paradox is simple. Following the crowd offers comfort, but it usually leads to bubbles or crashes. Herd behavior is rooted in how people handle uncertainty. Financial decisions come with incomplete information and risk. Most people aren't reading balance sheets or calculating intrinsic value. Even those who do are guessing about the future. When faced with doubt, people often rely on the behavior of others as a shortcut. If a large group of investors is buying a certain stock, real estate asset, or cryptocurrency, that behavior alone becomes persuasive. The logic is often unspoken. They can't all be wrong. That's the start of a bubble. Early investors buy based on fundamentals or future potential. Their buying drives prices up. Others see the rise and assume it reflects quality or opportunity. More investors pile in, not because they've done deep analysis, but because others already have. The rising price becomes its own justification. The longer it continues, the more it attracts new attention. At some point, prices disconnect from reality. The herd doesn't notice or doesn't care. Momentum overrides logic. This dynamic played out in the housing market before the 2008 financial crisis. People kept buying homes because prices were going up. Lenders offered mortgages to almost anyone. Homeowners believed that if they couldn't afford payments, they could just sell at a profit. Everyone else was doing it. Construction boomed. Speculation soared. House flipping shows aired in prime time. Felt like a good time to buy because everyone was buying. But under the surface, the fundamentals were rotting. Prices rose far beyond what incomes could support. Loans were packaged into securities no one fully understood. When defaults started and prices fell, the herd reversed. Everyone tried to sell at once. The bubble burst and the damage spread globally. The same pattern appeared during the dot-com boom in the late 1990s. Tech companies with no profits or even revenue were trading at massive valuations. It wasn't just professionals. Everyday people were buying stocks on hunches, tips, and headlines. If a company added .com to its name, its stock could double overnight. The logic was rarely based on performance. It was driven by the fear of missing out. No one wanted to be the last to buy. The herd charged in, and when it all collapsed, trillions of dollars vanished. Even smaller examples follow the same template. In early 2021, the GameStop saga revealed how quickly a herd can form and how irrational it can become. Retail investors, organized through online forums, pushed up the stock of a struggling company to levels completely detached from its financial reality. Some were protesting Wall Street, others just wanted in on the action. Social media made the crowd bigger, louder, and faster. The movement became less about the company and more about momentum. People bought because others were buying. It worked until it didn't. The stock eventually crashed back to earth, leaving latecomers with heavy losses. Herd behavior doesn't only inflate bubbles. It also intensifies crashes. In a falling market, investors don't calmly assess fundamentals. They look at what others are doing. If the market is down 5%, many panic. They sell to avoid further losses, which adds to the selling pressure. The herd rushes for the exits. Rational analysis gives way to reflex. In this way, herding accelerates downturns. Bad news triggers emotional reactions. Prices fall too far, too fast. Then the same investors who bought at the top sell at the bottom. The paradox is that acting alone is terrifying, but acting with the crowd is often dangerous. Independent analysis takes effort and carries the risk of being wrong. Going against the group feels exposed. But in markets, safety in numbers can lead everyone over the edge together. Herds can't see cliffs. They just move. This behavior isn't limited to retail investors. Institutions and professionals herd too, just in more complex ways. Fund managers watch benchmarks and peers. If everyone is overweight in a hot sector and you're not, you risk underperforming. That underperformance could cost you your job. So you follow. You buy what others buy. You mimic the portfolio, even if your own judgment says it's overpriced. This is called career risk. It's one reason why bubbles keep growing longer than they should. It's not that everyone believes in the price. It's that no one wants to be the first to admit it's wrong. Algorithms have their own version of herding. Many trading programs follow similar rules: momentum signals, volatility triggers, and pattern recognition. In a fast market, they can all start buying or selling at the same time. What looks like individual trades becomes a mass movement. Speed amplifies the effect. The result is a flash crash or a runaway rally. Machines don't feel fear, but they react to the same inputs. When those inputs align, the outcome mirrors human herding. It's hard to resist the herd because it offers emotional relief. If your investment goes wrong, but everyone else did the same thing, the loss doesn't feel as painful. But if you go against the crowd and you're wrong, the failure feels personal. That social cost drives people to conform. Behavioral finance calls this social proof. It's the tendency to assume a decision is correct because others are making it. But in markets, social proof is often the first step toward collective error. What makes herding so dangerous is how quickly it feeds on itself. Price increases justify more buying. Price drops justify more selling. Feedback loops form. Investors don't reassess, they react. A 5% gain convinces them it will go up another 5%. A 5% loss convinces them it will keep falling. There's no long-term thinking, just crowd movement. The irony is that many investors claim to seek value. They talk about buying low and selling high, but herding often makes them do the opposite. They buy high because others are buying. They sell low because others are selling. They follow signals that feel right in the moment but ignore the deeper logic. In this way, herd behavior turns rational goals into irrational actions. Markets function best when people think independently, but independence is uncomfortable. It requires accepting the possibility of being wrong alone. Herding offers the opposite, the comfort of being wrong together. That's why it's so common, and that's why it so often ends in disaster. The very thing that makes herding feel safe is what makes it dangerous. When too many people move in the same direction, the exit becomes too narrow when the mood shifts. What felt like security turns into a stampede. Debt is one of the oldest tools in finance. It allows people, businesses, and governments to access money they don't yet have, in exchange for a promise to repay it later with interest. Done well, debt unlocks opportunity. A worker borrows to buy a car and gets a better job. A business takes out a loan, expands operations, and grows its revenue. A government issues bonds to fund infrastructure, schools, and hospitals. In every case, debt fuels forward motion. Without it, many investments, especially large ones, would never happen. But the same mechanism that builds also destroys. Take on too much debt, and the burden of repayment crushes growth. Interest payments pile up. Cash gets drained. Defaults rise. The very thing meant to create wealth now erodes it. This is the debt paradox. Borrowing drives progress until it drives collapse. Start with the household. Most people don't buy homes in cash. Mortgages are a form of long-term debt that make homeownership possible. In theory, the homeowner uses debt to secure a stable place to live, build equity, and eventually own the home outright. If the buyer chooses a reasonable loan, stays within budget, and keeps earning a steady income, the system works. Over 30 years, the loan is paid off. The house appreciates. Wealth is created. But shift the scenario. A borrower takes on too much mortgage debt, assuming housing prices will keep rising. They stretch their income, buy a more expensive house than they can afford, or rely on adjustable rates that balloon over time. If interest rates rise, or if they lose a job, the payments become unmanageable. They miss a few months. Foreclosure looms. The dream of homeownership turns into a financial trap. What began as a tool for stability becomes the cause of instability. The 2008 housing crisis shows this clearly. Cheap credit, lax lending, and speculative behavior led to a wave of overborrowing. People were encouraged to buy homes with little or no down payment, using loans they didn't fully understand. Banks packaged these loans into complex securities, betting that home prices would always rise. For a few years, it worked. Housing markets boomed. Construction flourished. Consumers felt rich. But the debt piled up. When prices flattened, then fell, the weight of that debt crushed everything beneath it. Banks collapsed. Families lost homes. Governments intervened to prevent a total economic breakdown. Debt is powerful because it brings future money into the present. This gives borrowers a head start, but it also commits them to future obligations. When the return on borrowed money exceeds the cost of borrowing, debt builds wealth. But when the cost outpaces the return, debt eats into the very gains it once made possible. That tipping point is where growth turns to collapse. Businesses use debt to finance operations, purchase equipment, or expand into new markets. Corporate debt can increase efficiency and profits if used well. A factory borrows to modernize its production line. A retailer opens new locations. As long as revenue outpaces interest and repayment, the model is sustainable. Investors often reward firms that take on productive debt because it signals confidence and ambition. But like households, businesses can take on too much. During good times, they may borrow aggressively, assuming that growth will continue. They refinance, restructure, and take advantage of low interest rates. If markets shift or demand falls, those debt payments become a burden. Servicing the debt consumes cash that should go to wages, research, or product development. The company starts cutting. Layoffs follow. Growth stalls. Eventually, if debt becomes unpayable, bankruptcy is the result. Investors lose. Workers suffer. A business once poised for expansion shrinks or disappears. Governments are not immune. Public debt funds roads, defense, pensions, healthcare. When managed responsibly, this debt supports long-term growth. Borrowing during recessions helps stabilize the economy through stimulus spending. Issuing bonds allows investment in infrastructure that takes decades to pay off, but serves generations. But governments, too, face the debt paradox. When debt grows faster than the economy, the interest burden begins to choke the budget. Payments on past borrowing crowd out current spending. A larger share of taxes goes to bondholders, not services. In extreme cases, governments must cut benefits, raise taxes, or default altogether. In countries with high sovereign debt, like Greece in the early 2010s, debt ceilings became cliffs. When confidence collapsed, borrowing costs surged. Investors demanded higher yields. Debt became harder to roll over. Austerity was imposed. Services were cut. The economy shrank. Unemployment soared. Debt as a tool for national investment became a national crisis. On a global scale, the debt paradox reveals itself in cycles. Periods of easy credit lead to borrowing binges. Households, firms, and governments all spend beyond their means. Debt inflates asset prices. The economy appears strong, but under the surface, obligations accumulate. When credit tightens due to rising interest rates, inflation, or external shocks, those obligations become visible. The cycle reverses. Borrowers rush to deleverage. Spending slows. Defaults spike. A slowdown turns into a recession. The paradox is that the debt-fueled growth makes the economy more fragile. What looked like strength was leverage. Central banks often try to manage this cycle. They lower interest rates to encourage borrowing in bad times. They raise rates to prevent overheating, but their control is imperfect. Sometimes rates stay low too long. Borrowing becomes excessive. Risk-taking increases. At other times, they tighten too quickly, triggering the very downturn they hope to avoid. Policymakers are always caught between supporting growth and avoiding collapse, between encouraging borrowing and containing its dangers. The paradox plays out in personal finance as well. Credit cards, payday loans, and buy now, pay later services offer access to goods today at the cost of tomorrow's income. Used carefully, credit provides flexibility. Used recklessly, it leads to cycles of debt dependence. A $500 emergency becomes a $1,000 debt over time. Late fees, compounding interest, and minimum payments trap consumers in long-term obligations that far exceed the original need. The convenience of debt masks its long-term cost. Debt is not inherently bad. It is a neutral tool. In skilled hands, it accelerates growth, funds innovation, and smooths life's uncertainties. But in careless hands, or when overused, it multiplies fragility. The tipping point often isn't obvious. It doesn't arrive with a bang. It builds quietly. Debt levels rise. Interest obligations creep up. Cash flow tightens. The system becomes brittle. A single shock, job loss, rate hike, missed payment, snaps the balance. This is the essence of the debt paradox. What begins as an engine for growth becomes a drag on the future. The more debt fuels expansion, the more sensitive the system becomes to stress. And once momentum shifts, it's hard to reverse. Borrowers must pay down old obligations before they can invest again. Growth slows further. The system enters a negative feedback loop. Understanding the debt paradox means recognizing that more is not always better. Borrowing can be wise, can also be reckless. Debt is a bet on the future. It assumes stability, growth, and the ability to repay. But the future is unpredictable. When those assumptions fail, the same debt that built wealth becomes the weight that breaks it. A cheap stock often catches the eye of investors looking for a bargain. It trades at a low price-to-earnings ratio, or well below its historical average. Maybe it's trading below book value. Maybe the price has fallen 60% over the past year. On paper, it looks like an opportunity. Buy low, wait for the market to recognize its mistake, then sell high. That's the thinking. But here's the problem. Cheap can always get cheaper. Just because a stock is down doesn't mean it's done falling. The cheap stock paradox reminds investors that low valuation is not the same as good value. A stock trades at a low price for a reason. Sometimes that reason is overreaction. The market panics after a bad quarter. News hits hard, and sentiment drops faster than the numbers justify. If the business remains sound, then a temporary decline can be a buying opportunity. But often, a falling stock signals real, lasting problems. The business model may be breaking down. Revenue could be shrinking. Costs might be rising. Management may have lost credibility. Or the company could be in a dying industry. A cheap stock may reflect risk more than reward. Take a company trading at 5 times earnings. That sounds like a deal, especially when the market average is closer to 20. But if those earnings are falling every quarter, the multiple is misleading. If a company earned $2 per share last year but is only expected to earn $1 this year, the true multiple doubles. And if those earnings go to zero, there is no multiple. The company is now just a name with a stock price. That price may be low, but it's not cheap in a meaningful way. It's cheap because nobody wants it, and they may be right. Investors often confuse low price with undervaluation. They see a stock trading at $3 and assume it must be a better buy than one at $300. But price alone means nothing. A $3 stock with no earnings, no growth, and mounting losses could be headed to $0. Meanwhile, the $300 stock might be growing profits at 20% a year, with strong margins and a solid balance sheet. Cheapness is not defined by absolute price, but by value relative to quality. A stock is only undervalued if it's trading below the value of what it can reasonably produce in the future. And that's harder to measure than it looks. The cheap stock paradox becomes dangerous when investors fall into the trap of mean reversion. They assume that a stock that once traded at $50, now trading at $10, must eventually bounce back. They think the market will realize its mistake and the price will correct. But there's no rule that says a stock must return to its past highs. Companies change. Markets evolve. A business that earned money 5 years ago may never recover. Retailers go bankrupt. Tech companies get outpaced. Industries get disrupted. A cheap stock may simply be a fading company with no real path back to relevance. One example is BlackBerry. Once a leader in mobile phones, it began to decline when Apple and Android took over. For years, investors pointed to its cheap valuation as a reason to buy. But the fundamentals kept deteriorating. The company lost market share. Revenue dropped. Even though it tried to reinvent itself as a software company, the transition took too long. The stock kept falling. It looked cheap the whole way down. The same happened with Sears, Kodak, and many others. They looked cheap for years, but their business models were broken. The market was not wrong. It was pricing in decline. Another layer to this paradox is the role of liquidity. A cheap stock may trade at a low volume. That makes it harder to enter or exit positions without moving the price. Investors may find themselves stuck, unable to sell without taking a loss. This risk doesn't show up in the stock's valuation metrics, but it's real. Low-priced, low-volume stocks can be illiquid traps. The bid-ask spread widens. Volatility increases. Small trades can lead to large price swings. The risk is not just that the stock gets cheaper, it's that you can't get out when you need to. There's also the psychological aspect. Investors tend to anchor their expectations to previous highs. If a stock once traded at $100 and now sits at $15, they imagine a return to $100 as a realistic outcome. But that's not investing, that's hoping. Hope is not a strategy. Anchoring to old prices ignores the reason the stock fell in the first place. It assumes the past is a guide to the future, when in many cases it's a warning. The cheap stock paradox teaches that due diligence is critical. Before buying a low-priced stock, investors must ask hard questions. Why is it cheap? What does the market see that I'm missing? Are the earnings sustainable? Is the debt manageable? Is the business model still relevant? Does management have a plan, and can they execute it? A stock may be cheap for good reason, and in many cases the price is telling the truth. Another issue is timing. Even if a cheap stock is truly undervalued, it may stay cheap for a long time. The market doesn't always recognize value immediately. A turnaround could take years. During that time, the stock might drift sideways or continue to fall. This dead money risk ties up capital that could be earning returns elsewhere. A stock that looks cheap but moves nowhere for 5 years is not a good investment. Patience is important, but so is opportunity cost. There's also survivorship bias in the stories people tell. When a cheap stock rebounds, it becomes a legend. People talk about how they bought it at $2 and sold it at $20. But they don't talk about the 10 other stocks they bought at $2 that went to zero. The market rewards those who get it right, but the odds of success in turnaround situations are low. For every winner, there are many that never come back. Chasing cheap stocks without a margin of safety is more like gambling than investing. A better approach is to focus not on how cheap a stock is, but why it's cheap, and whether the reasons are likely to change. Sometimes, cheapness signals opportunity. More often, it signals trouble. Stocks with strong balance sheets, growing revenue, and competent leadership may be overlooked temporarily. That can create value. But stocks with deteriorating fundamentals and shrinking relevance are cheap for a reason. They don't deserve a higher price. The paradox reminds investors to be careful with the idea of bargains. Not everything on sale is worth buying. In investing, a low price tag often hides high risk. A stock at $2 can lose 100% just as fast as a stock at $200. And the cheaper it gets, the more tempting it looks until it disappears. Long-term investing is often held up as the gold standard of financial wisdom. It's what seasoned investors recommend. It's backed by decades of data showing that staying invested through ups and downs leads to better results. Compound growth takes time, and markets tend to reward patience. But despite this, most investors behave in ways that are shaped by short-term noise. They check prices daily. They panic during market dips. They chase trends and headlines. They say they're in it for the long haul, but they act as if every week is the end of the game. This is the long-term versus short-term paradox. Investors claim to think long-term, yet most of their actions are driven by short-term reactions. This paradox begins with how people experience risk. Long-term investing works best when you ignore short-term movements. But markets are noisy. Stocks rise and fall every day. Financial news runs 24/7. Social media pumps out opinions, predictions, and panic. When you're constantly exposed to this stream of information, it's hard not to react. A portfolio that dropped 20% over a month doesn't feel like a minor blip in a decades-long plan. It feels like something is wrong. The emotional response kicks in. Sell before it gets worse. Consider a retirement investor with a 30-year horizon. They hold a diversified index fund. Historically, this kind of investment delivers reliable returns over time, despite occasional downturns. The plan is to keep adding money each year and not worry about market fluctuations. But 1 year into the plan, a recession hits. The market drops 25%. Headlines warn of a financial crisis. The value of the portfolio falls sharply. The investor starts to second-guess everything. What if this isn't just a dip? What if the market won't recover this time? The plan was long-term, but the reaction is short-term. They sell. This kind of behavior is common. Data from brokerage platforms shows that most individual investors underperform the very funds they invest in. This is not because the funds are bad. It's because investors jump in and out at the wrong times. They buy after prices rise. They sell after prices fall. They react to short-term movements, trying to time the market, even when they claim to be in it for the long term. The paradox is also reinforced by the structure of the financial industry. Fund managers are evaluated on short-term performance. They have to show quarterly results. If they underperform for even a few quarters, they risk losing clients or their jobs. This pressure leads them to make short-term decisions, even when they know the long-term view would be better. The same applies to media. Financial news outlets don't thrive on long-term thinking. They thrive on drama, volatility, and daily updates. A headline saying, "Stay the course for 20 years," doesn't get clicks. Market crash incoming does. Even the tools investors use encourage short-term thinking. Mobile trading apps put market data at your fingertips. You can watch your net worth change minute by minute. The easier it is to check, the harder it is to ignore. This instant access increases anxiety. Investors become more focused on what their portfolio is doing today rather than what it will do over a decade. There's also a psychological element. Long-term goals feel abstract. Retirement is far away. College funds take years to grow. But a market loss today is real and painful. Behavioral finance calls this loss aversion. The idea that losses hurt more than equivalent gains feel good. So when the market drops 10%, investors feel a strong emotional urge to act, even if the best move is to do nothing. Markets themselves are built on the tension between short-term volatility and long-term trends. In the short term, prices reflect emotions, news, and speculation. Over time, they reflect business fundamentals, earnings, and economic growth. A company's stock might fall because of a rumor, even if its long-term prospects are strong. Or it might rise on hype, even if it's not profitable. The investor who focuses on the short term sees noise. The one who focuses on the long term sees value. Warren Buffett has talked about this paradox often. He says the stock market is designed to transfer money from the impatient to the patient. But patience is hard. It means watching your investments fall without reacting. It means holding boring assets while others chase trends. It means sticking to a strategy even when it feels uncomfortable. Most people know this intellectually, but emotionally they struggle. A classic case of this paradox came during the 2020 pandemic. In March, markets crashed. Investors fled for safety. Some sold at the bottom. But just a few months later, markets had recovered. By the end of the year, many indexes had made new highs. The investors who stayed put saw their portfolios rebound. The ones who sold locked in losses. The event revealed who truly had a long-term mindset and who only thought they did. Another layer of the paradox is how people define long-term. For some, it means 3 years. For others, it means 30. But real long-term investing means decades. It means accepting that in any given year, your investments might go down. It means understanding that there will be recessions, corrections, and panics. And it means preparing for that emotionally and financially. There are ways to resolve the paradox, but they require discipline. One approach is to automate investing. Set up regular contributions to a long-term portfolio and don't look at it often. This removes emotion from the equation. Another is to define your investment horizon clearly and align your strategy with it. Money needed in the next few years should not be in stocks. That's for long-term capital. Having a buffer prevents short-term needs from disrupting long-term plans. Investors can also benefit from reframing how they view volatility. Instead of seeing downturns as threats, see them as expected. Market declines are not interruptions. They are part of the process. Every long-term chart of market growth includes major drops. But over time, the general direction is up. Staying invested through these periods is what creates wealth. The long-term versus short-term paradox is ultimately about behavior. Most people understand what works in theory. Buy good assets, hold them, avoid panic. But their instincts push them in the opposite direction. They crave action. They fear loss. They react to noise. And in doing so, they undermine their own goals. To be a successful investor, one must not only choose a sound strategy, but also resist the urge to abandon it when the market gets loud. Knowledge is power. That's the idea we've been taught since childhood. The more you know, the better your decisions. The better your decisions, the better your outcomes. In theory, access to more information should make you more accurate, more precise, more capable. But in practice, there's a twist. More information often gives the illusion of understanding without delivering actual insight. It leads to confidence without accuracy. That's the knowledge paradox. The more people know, the more confident they become, even when their decisions aren't improving. The human brain craves certainty. When it receives new information, especially if that information appears detailed or technical, it often interprets that as deeper understanding. But not all information is equal. Some is noise. Some is contradictory. Some is completely irrelevant. Yet once it's absorbed, it still affects our perception of how much we think we know. This leads to overconfidence, even when the data is misleading or misunderstood. Take investing. A beginner reads a few articles about market cycles, studies some charts, and listens to a podcast or two. Suddenly, they feel prepared. They've seen historical returns, learned some jargon, maybe even watched a few videos on technical analysis. The data is flowing, and with it comes a sense of control. They make trades based on patterns they think they recognize. When one or two work out, it confirms their new confidence. But what they don't see is the vast field of knowledge they've yet to encounter: macroeconomic shifts, hidden correlations, behavioral traps, liquidity risks. Their small slice of knowledge gives them just enough confidence to make big mistakes. This is common in any domain where decisions are complex and outcomes are uncertain. In medicine, a patient might read about their symptoms online. They see a few possible conditions listed and decide which one fits best. They then question a doctor's diagnosis, convinced by the volume of material they've read. But volume is not depth. The information may be accurate, but without the context, experience, and training to interpret it properly, it can lead to the wrong conclusion. Worse, it can lead the patient to dismiss expert advice entirely. In the legal world, this plays out when people try to represent themselves in court. They read laws, watch courtroom shows, maybe even look at a few cases online. They come in confident, thinking they understand how the system works. But law is about precedent, strategy, and subtle interpretation. What seems clear on paper often plays out very differently in a real legal proceeding. Their newfound knowledge gives them a false sense of readiness. The paradox deepens in the information age. Today, knowledge is abundant. You can look up anything, anytime. You can get data, context, commentary, and analysis within seconds. But more doesn't mean better. In fact, the easier it is to access information, the less effort we put into filtering it. We absorb facts without asking how reliable they are. We confuse repetition with truth. And the more we absorb, the more certain we feel, even when the information is shallow or biased. Cognitive science shows this clearly. People often mistake familiarity for understanding. If you hear a concept repeatedly, you begin to feel like you grasp it, even if you've never tested that knowledge or applied it. This is called the fluency effect. It makes people rate their understanding higher than it actually is. As a result, people often make poor decisions with high confidence. They don't second-guess themselves because everything feels familiar. This leads to mistakes that wouldn't occur if they had less information and more humility. This overconfidence isn't just personal. It plays out in institutions and policy decisions as well. A government agency receives more intelligence reports than ever before. Data flows in from satellites, analysts, sensors, and third-party sources. But instead of clarity, this flood of information leads to conflicting signals. Decision-makers rely on fragments they understand or that support their beliefs. They become overconfident in a flawed interpretation because they're surrounded by data. The sheer weight of information gives them the illusion of thoroughness. But information without structure is just clutter. In teams and organizations, the paradox leads to groupthink. Each person brings in different data points. The group discusses them, and everyone leaves the meeting feeling more informed. But often, instead of challenging assumptions, they align around the most confident speaker or the consensus opinion. The illusion of shared knowledge leads to action, but not always to better results. The team believes they've covered the issue because so much was said, yet the most important questions were never asked. The Dunning-Kruger effect also ties into this paradox. People with limited knowledge in a domain tend to overestimate their competence because they don't know what they don't know. They haven't yet learned enough to see the complexity. As knowledge increases, people go through a phase where they lose confidence. They see how much more there is to understand. True experts, oddly enough, are often less confident in their predictions because they're aware of all the variables. In contrast, those with partial knowledge feel emboldened. Think of someone who has just learned about nutrition. They read a few studies and now swear by a specific diet. They become evangelists, convinced they've found the truth. But actual nutrition science is messy. It changes with new evidence. It varies by individual. A trained nutritionist might be cautious and flexible, recognizing exceptions and nuances. But the new enthusiast, armed with limited but loud information, is rigid. More knowledge has made them less open-minded. This paradox plays out in hiring as well. A manager reads multiple resumes, sits through interviews, and uses software to screen candidates. They gather more data than ever before. But the flood of information can lead them to overweight unimportant signals, like the name of a university or how confidently someone answers a question. They may skip the quiet candidate with more substance in favor of the polished speaker who tells them what they want to hear. They feel more confident in their choice, but the data didn't help them make a better decision. Even in everyday life, the knowledge paradox shapes how we see ourselves. People who read widely may begin to see themselves as informed across many subjects. They join debates, take firm positions, and offer advice. But without depth in those areas, their opinions often lack nuance. The illusion of knowledge replaces actual understanding. Meanwhile, the people who know the most, who understand how complex and conditional things really are, often speak more cautiously. They hedge. They explain trade-offs. They sound less certain even though they're more right. The solution to the knowledge paradox isn't to avoid learning. It's to treat knowledge with humility. More information is only helpful if you understand how to weigh it, question it, and apply it. Otherwise, it's just noise disguised as insight. A company reports record earnings. Revenue is up. Profits are higher than ever. Margins are strong. Operating costs are under control. The business is growing in all the right places. And yet, the stock drops. To someone unfamiliar with the way markets actually behave, this seems irrational. Shouldn't strong earnings push the price up? If a company is doing well, shouldn't investors reward it? This is where the earnings paradox comes in. Stock prices don't rise or fall simply because of a company's earnings. What matters more is how those earnings compare to what investors expected. A company can report strong numbers on paper and still see its stock price drop if those numbers came in below forecasts, or if guidance suggests slower growth ahead. On the other hand, a company can report lower earnings than the previous quarter and see its stock rise, if those results beat what investors feared. In this way, expectations shape the market far more than actual results. Investors don't trade on today's numbers. They trade on their beliefs about the future. That includes forecasts, guidance, economic indicators, competitive positioning, and sentiment. If a company reports that its earnings are up 10% year over year, that might sound good. But if analysts were expecting 15%, the market reacts with disappointment. The earnings, in absolute terms, are strong, but relative to expectations, they are weak. This dynamic plays out every quarter in the earnings season. Analysts issue estimates. The company issues guidance. Investors try to anticipate whether the company will beat or miss those targets. A beat means actual results exceeded expectations. A miss means they fell short. Even a tiny miss can lead to a big drop in share price. It's not about the raw performance, it's about how that performance compares to what the market priced in. Consider a tech company that just posted a 20% increase in earnings. Revenue grew. User numbers are up. But if the company had hinted at 25% growth in previous guidance, or if Wall Street analysts had forecast higher earnings, the stock might tumble. Investors had already baked in that higher figure. When reality came in below that level, even if it was still positive, market sentiment shifted. Disappointment, not celebration, followed. In that moment, perception outweighed performance. This paradox becomes even clearer when looking at high-growth companies. These businesses often trade at high price-to-earnings ratios because investors expect rapid growth. The valuation already assumes big future earnings. When those companies report results, they have to do more than just perform well. They have to outperform sky-high expectations. If growth slows even slightly, the stock can plunge. Investors didn't just buy the company's current performance. They bought a vision of explosive growth. Anything that threatens that vision hits hard. Tesla is a classic example. Over the years, it has reported strong earnings and impressive delivery numbers. But the stock has still swung wildly depending on guidance, future delivery estimates, and comments from leadership. When expectations are built around exponential growth, even a modest slowdown, despite solid earnings, can lead to sell-offs. Investors who bid up the price based on future scenarios reevaluate when new data suggests those scenarios may not play out as hoped. In contrast, companies with low expectations have more room to surprise. A struggling retailer might report a small profit after a string of losses. Analysts expected another loss, so the news is a pleasant surprise. The result? The stock price jumps. The actual earnings are worse than many other companies in the same sector, but relative to expectations, it was a success. This makes investing counterintuitive. Good news doesn't always mean rising prices. Bad news doesn't always mean declines. The market constantly adjusts prices based on expectations and then readjusts them when new information comes in. This is why you'll sometimes see a company post a loss and rally 15%, while another posts record profits and drops 10%. One beat expectations, the other missed. There's also a forward-looking element that adds to the complexity. A company might report excellent past performance, but if it issues weak guidance for the next quarter, investors react to the warning, not the history. Markets are discounting mechanisms. They value what lies ahead, not what's behind. That's why earnings calls are so closely watched, not just for numbers, but for language. If a CEO says, "We expect slower growth in the second half of the year," that comment can overshadow a great quarter. Forward guidance has more weight than current figures. This explains why volatility often increases after earnings reports. It's not the data itself, it's the interpretation of that data relative to what was assumed before. Investors constantly ask, "Was this better or worse than we thought?" And that question drives price movements. This also highlights why earnings estimates play such a crucial role. Analysts set targets. Those targets shape investor expectations. When a company beats those estimates, the market sees it as a signal of strength. When it misses even slightly, it's seen as a red flag. But those estimates are not always grounded in reality. They're often speculative, and yet they guide behavior. A company's stock might rally simply because it beat by a penny, even if the broader picture is unchanged. This shows how expectations can detach from fundamentals. The paradox is reinforced by short-term traders who thrive on these earnings beats and misses. They aren't interested in holding for the long term. They're playing the game of reaction, trying to get ahead of the market's response to earnings surprises. Their trades amplify price swings. This contributes to the mismatch between earnings strength and stock performance. The market isn't rewarding the company. It's reacting to the surprise. Earnings themselves are not the sole driver of stock prices. They are just one piece of a larger picture that includes guidance, macroeconomic factors, sector trends, and investor sentiment. A strong quarter can be overshadowed by rising interest rates, geopolitical uncertainty, or weakness in other companies within the same industry. Investors don't operate in a vacuum. They make decisions based on a complex web of influences, of which earnings are only one part. This doesn't mean earnings don't matter. Over the long term, they do. Companies that consistently grow earnings tend to see their stock prices rise. But in the short term, especially around earnings season, it's the delta between expectations and results that matters most. Investors don't reward good performance. They reward performance that's better than what was already expected. Understanding the earnings paradox helps investors manage emotions around earnings reports. It reminds them that a stock's movement isn't always about business fundamentals. It's about what the market assumed before the numbers came out. And those assumptions are constantly shifting. Buy and hold is one of the most praised investment strategies. It's simple. You pick quality assets, usually broad index funds or strong individual stocks, and hold them for the long term. You don't time the market. You don't jump in and out. You just stay the course. Over decades, the historical data supports it. Markets tend to go up over time. Compound growth does the heavy lifting. Transaction fees are minimized. Taxes are deferred. Volatility gets smoothed out. The longer the timeline, the more buy and hold seems unbeatable. But there's a catch that doesn't show up in charts or backtests. You actually have to hold through everything. And that's where most investors break. The buy and hold paradox is that the strategy works on paper, but most people can't follow through when it matters most. It's not hard to buy. It's not even hard to hold when times are good. The real test comes during brutal downturns, when everything in you screams to sell. The numbers drop. The news turns dark. Your portfolio bleeds red. In those moments, the plan feels foolish. You tell yourself this time might be different. That holding isn't discipline. It's denial. Consider the 2008 financial crisis. The S&P 500 lost more than 50% from its peak. Over the course of about 17 months, the market plunged. Lehman Brothers collapsed. Banks failed. Real estate crashed. Headlines warned of another Great Depression. In that environment, holding a stock portfolio didn't feel brave. Felt reckless. Investors who stuck to buy and hold saw their wealth cut in half. And for many, that was too much. They bailed out. They sold at the bottom. They missed the recovery. Those who truly held through the storm, without selling, without hedging, without flinching, eventually came out ahead. The market recovered. Dividends resumed. Compound interest kicked back in. But to get there, they had to endure panic, doubt, and the appearance of ruin. The strategy worked, but it demanded something most people couldn't give: emotional resilience under fire. A similar story unfolded during the COVID-19 crash in early 2020. The market fell 30% in about a month. That speed was terrifying. Travel stopped. Cities shut down. The economy stalled. Investors faced a fast, steep drop, with no clear sense of how bad things would get. Some sold early. Others sold at the bottom. But the market snapped back almost as fast as it fell. Those who sold had to decide when to get back in, and most didn't do it in time to catch the recovery. Once again, buy and hold worked for those who could actually hold. The paradox is amplified by how we experience loss. Losses hurt more than gains feel good. This isn't theory, it's behavioral psychology. A 30% drop in your portfolio doesn't just register as a financial event. It's emotional, feels like failure, causes stress, and when it happens quickly, it creates panic. Investors in those moments aren't thinking about 30-year charts. They're thinking about the money they might never get back, the plans they'll have to delay, the safety they thought they had but don't feel anymore. Buy and hold requires investors to do the opposite of what their emotions tell them. It asks for conviction when doubt is everywhere. It asks for calm in the middle of chaos. And it asks for faith in a future that seems uncertain. That's why the strategy works, because it's hard. The rewards come to those who can wait, but more importantly, to those who can endure. It also asks for a level of financial stability that not everyone has. Holding through a downturn is easier when you don't need to sell. If your job is secure, your bills are covered, and your emergency fund is full, then a bear market is a paper loss. But if you lose your income, or if you face unexpected expenses, you might be forced to sell at the worst time, not because of panic, but because of necessity. That's not an emotional failure. It's a structural risk. It shows that buy and hold also depends on external stability, not just internal discipline. Even among those who do have the ability to hold, few prepare for the pain of it. They read about 7% average returns and assume the path will be smooth. They imagine compounding like a staircase, but the market doesn't move like that. It surges, stalls, crashes, recovers, repeats, tests conviction. Long-term investors are guaranteed to face multiple bear markets. Each one will feel like it might be the last. Each one will come with headlines saying this time is different. And each time, the right move will still be to hold, if the underlying strategy and holdings remain sound. Buy and hold also becomes more difficult in a culture of immediacy. We're trained to expect quick results. News cycles are fast. Social media amplifies every dip and spike. We check our accounts daily, even when we say we're long-term investors. Every small loss becomes a signal. Every headline adds to the noise. In that environment, holding for decades requires not just strategy but silence, an ability to tune out short-term distractions and remember the actual timeline you committed to. That timeline matters. Buy and hold only works if you give it time. If you plan to hold for 5 years, you're not really using the strategy. That's still within the window of short-term market cycles. Real buy and hold is 10, 20, 30 years. It's the strategy for retirement accounts, for legacy planning, for building generational wealth. And that long arc makes the downturns survivable. Over 30 years, even a 50% crash is a dip, not a disaster. But over 3 years, it feels like a catastrophe. Most investors think they're long-term until the short-term pain shows up. Time is what makes the strategy work. But time alone isn't enough. You need the psychological strength to stick with it. That's the hidden cost of buy and hold. It's not about intellect. It's not about financial modeling. It's about temperament. It rewards those who can delay gratification, withstand discomfort, and ignore the herd. And even then, the paradox stays sharp. The more you know how well buy and hold works, the harder it becomes to watch others succeed with risky trades in the short term. When a meme stock doubles overnight or a speculative bet pays off, long-term investors can feel left behind. The slow, steady path seems boring, but that boredom is a feature, not a flaw. Long-term wealth is built slowly. It doesn't make headlines. It doesn't spike, but it does endure if you can hold. The strategy is simple. Execution is not. Buy and hold isn't about buying at the right time. It's about not selling at the wrong time. That's what most people fail to do. That's why the strategy works, but only for those who stay. Every investor wants alpha. It means outperforming the market, beating the benchmark, doing better than the average. It's the goal behind most active strategies. Fund managers chase it. Hedge funds market it. Individual investors hope for it. Alpha is the prize for being right when others are wrong, for spotting what others miss, for taking smart risks and reaping the reward. But here's the problem. The market is made up of investors. It is not some separate machine to be outwitted. It's the average of all decisions made by everyone putting money in. And most people, by definition, can't beat the average. For every investor who earns alpha, another must lag behind. That's the alpha paradox. Everyone wants to outperform, but together they are the market. The average return is the benchmark, and you can't all be above average. This truth is uncomfortable, especially for professionals. If a mutual fund manager earns 2% above the S&P 500, someone else must have underperformed by 2% to balance the scale. The stock market doesn't produce alpha on its own. It produces returns, some years better, some worse. Alpha is relative. It's performance above that average. So for one investor to gain an edge, another must unknowingly give one up. This becomes even clearer when you factor in fees. Active managers charge more. That higher cost must be justified by better performance. But over time, the numbers show that most active funds don't outperform their benchmarks once fees are included. Some do, especially in short periods. But across 10 or 20 years, the majority fall short. The data from SPIVA S&P Indices versus Active reports this regularly. A small minority of active managers outperform consistently, and their identities often change. Past winners don't stay winners. For the average investor, this means that chasing alpha is more likely to lead to disappointment than success. You're not just trying to beat the market. You're trying to beat other investors, the ones who have more information, better tools, faster access, and often more experience. They aren't just guessing. They're pricing in every bit of news, every signal, every whisper of data. By the time you make a move based on a headline, it's already reflected in the price. The market has moved. Your edge is gone. That's not to say alpha doesn't exist. It does, but it's scarce, and it's not evenly distributed. A few investors achieve it by being early, being disciplined, or having an actual informational advantage. Some find it through behavioral consistency, doing the right thing when others panic. Others find it through deep, contrarian research. But for everyone who finds it, many more believe they have it and don't. The market humbles them over time. Consider a simple example. Imagine 10 investors. Each one believes they can beat the market. Each one has a strategy, a thesis, a reason to believe they'll do better than the average. But only one can be at the top. If 3 beat the average, the other 7 must fall below it. The group as a whole is the average. That's inescapable. No amount of ambition or confidence changes the math. The market is a zero-sum game before costs and a negative-sum game after costs. This paradox is hidden when markets rise. When almost everyone is making money, it's easy to think you're doing well. If your portfolio is up 12% and the S&P is up 10%, you pat yourself on the back. You believe you've found an edge. But if the S&P is up 25% and you're up 12%, you feel like you failed even though your portfolio grew. your perception of success changes based on what others are doing. That's the nature of alpha. It's not about making money. It's about making more money than someone else. This mindset can lead to reckless behavior. In the pursuit of alpha, investors often take on more risk than they understand. They chase hot sectors. They rotate strategies. They follow stories, tips, and short-term trends. The desire to outperform pushes them into trades they don't fully grasp. When markets turn, they're left exposed. The irony is that trying to beat the market often leads to underperformance. The more aggressively you chase alpha, the harder it becomes to catch. The paradox also explains the rise of passive investing. If most active strategies fail to beat the market after fees, then the logical choice is to accept the market return. That's what index funds offer. They don't seek alpha. They mirror the benchmark. And over time, they tend to outperform most actively managed funds. Not because they're smarter, but because they're cheaper, more consistent, and not subject to behavioral traps. Passive investors aren't trying to win. They're trying not to lose. And that turns out to be a better long-term strategy for most. Still, the allure of alpha persists. Investors don't just want average. They want to be above average. They want to win. It's an emotional goal as much as a financial one. That's why you'll always see new funds, new strategies, and new promises of outperformance. But the paradox remains. Everyone can't be above average. For one person to get alpha, another has to miss it. The more people chase it, the harder it is to find. It's worth noting that alpha, when it does appear, often comes from sources that don't look like genius in the moment. It can come from being patient during downturns, or from ignoring fads. It can come from buying when others are fearful and holding when others are greedy. These aren't glamorous strategies. They're quiet. They require doing nothing when others are doing everything. But that's where long-term edge often lies, not in prediction, but in discipline. This paradox should humble investors. It doesn't mean you should give up trying to improve your returns, but it does mean you should understand the odds. Alpha is hard to find. The market is efficient enough that easy wins are rare. Most of the time, your performance will mirror the market's, minus costs, mistakes, and emotions. And the more you accept that, the more clearly you can define what success really means. In the end, chasing alpha is less about skill and more about self-awareness. Knowing when not to act, knowing when to stick to your plan, knowing that trying to beat the market every day usually leads to beating yourself. The alpha paradox reminds us that in a market made of people seeking to win, most won't. The ones who do are rare. The rest are the market. When something is rare, people want it. That's human nature. Scarcity signals value. If only a few people can have it, it must be special. This logic applies to art, luxury watches, real estate, and especially financial assets. In markets, scarcity can drive demand far beyond what the fundamentals justify. Investors chase what's limited, not always what's rational. This is the scarcity paradox. The rarer something is, the more desirable it becomes, even if the underlying value doesn't support the price. This behavior shows up clearly in collectibles. Take fine art. A painting by a dead artist is, by definition, scarce. There will be no more. The supply is fixed. When one comes to auction, collectors bid not just on its beauty or cultural value, but on its rarity. The price isn't tied to earnings, cash flow, or production. It's tied to how few exist and how many want one. The same applies to vintage watches, first edition books, and baseball cards. Scarcity creates a kind of perceived value that lives outside of traditional valuation models. In financial markets, scarcity often plays out with assets that have fixed supply. Bitcoin is a classic case. There will only ever be 21 million Bitcoins. That hard cap is built into the code. As demand grows and supply remains fixed, the price rises. Many investors don't analyze it like a business. They don't ask for cash flow statements or earnings reports. They buy it because it's scarce and others want it. That expectation of future demand chasing limited supply becomes self-reinforcing. The price climbs not because of fundamentals, but because of belief in the power of scarcity. During Bitcoin's early rise, critics pointed out that it had no intrinsic value. produced nothing, paid no yield. It was just code. But that didn't stop the price from rising. In fact, those very critiques added to its mystique. If something so intangible could command so much attention and price movement, it must be special. Investors weren't just buying an asset, they were buying an idea. And part of that idea was scarcity. The same psychology that drives collectors also drives speculators. If everyone wants it and there's only a little of it, the price can keep going up. This logic also drove the non-fungible token NFT boom. NFTs are digital certificates that prove ownership of a unique digital item, a piece of digital art, a tweet, a video clip. In theory, anyone can copy the image or file, but only one person owns the original token. That idea of digital scarcity, creating rarity where none naturally exists, allowed people to sell JPGs for hundreds of thousands of dollars. It wasn't about the content. It was about owning something unique, even if it was only unique because of a line of code. The market didn't ask if the asset had long-term value. It asked how rare it was and how many people might want it next. Scarcity also plays a role in real estate, especially in cities with limited buildable land. Manhattan, London, and Hong Kong are expensive not just because they're economic hubs, but because there's not much room left. The scarcity of space pushes up prices. People don't just buy homes to live in. They buy because they believe the supply is limited and demand will keep rising. Even if rental income doesn't justify the price, investors hold onto property because they expect others to keep wanting what little there is. That expectation turns scarcity into a pricing engine. But scarcity can distort judgment. When an asset becomes desirable simply because it's rare, fundamentals can fall by the wayside. Investors stop asking what it's worth. They only ask what someone else might pay later. The asset becomes a speculative vehicle, driven by sentiment and fear of missing out. This disconnect between value and price can persist longer than expected. Bubbles form, and when sentiment shifts, they pop. The tulip mania in 17th century Holland is one of the earliest examples. Certain tulip bulbs became incredibly rare and desirable. Their uniqueness, due to viral infections that caused unusual color patterns, made them status symbols. Prices soared. At the peak, a single bulb could sell for more than a house. But the bulbs had no productive value. They didn't generate income. Their worth came from their rarity and the belief that someone else would pay more. When the market shifted and people stopped believing in the scarcity premium, prices collapsed. The fundamentals hadn't changed. The perception of value had. Scarcity doesn't always mean value. A rare item is only valuable if people want it. Plenty of things are scarce but worthless. A coin minted with an error might be rare, but if collectors don't care, it has little market value. The same is true of obscure stocks with low float. They may be hard to buy, but that doesn't make them good investments. Rarity is a necessary condition for premium pricing, but not a sufficient one. There must be demand. Sometimes the perception of scarcity is artificial. Companies or sellers can manufacture it to drive prices up. Limited editions, exclusive drops, and only 1,000 available campaigns use scarcity as a marketing tool. When people believe that availability is low, they act quickly and emotionally. This tactic works in markets too. A stock with a low public float might be hyped as scarce. Traders jump in, thinking the tight supply will send the price soaring on any positive news. This creates volatility and price distortion, even when the underlying company has weak fundamentals. Scarcity also makes investors less rational. When something is rare, people assume it must be valuable, even if they don't understand it. This creates the illusion of value. They don't want to miss out. They imagine what others might pay. They fear being left behind. This fear drives demand, which raises prices, which validates the fear. The loop continues. Scarcity becomes its own justification. This is how hype-driven markets operate. They rely on belief, not balance sheets. Traders ride momentum, not earnings reports. Scarcity gives them a reason to hold or to chase. But that same scarcity can become a problem when liquidity dries up. If few assets are available and prices are high, it only takes a small shift in sentiment to trigger a large drop. There may be few willing buyers at the new, lower price. What was once an asset prized for its scarcity becomes illiquid and risky. The advantage flips. The scarcity paradox warns that rarity alone is not enough. Can attract attention, can create temporary price spikes, but it doesn't guarantee durability. When investors buy based solely on how little of something exists, they are gambling on sentiment, not value. That's a fine game if they know they're playing it. But many don't. They assume the price reflects something deeper. They believe scarcity means safety. It doesn't. It only means fewer people can own it. It says nothing about what it's worth. Compounding is simple. You earn returns not just on your original investment, but on the returns you've already earned. Over time, the gains build on themselves. $1 becomes 2, then 2 becomes 4, then 4 becomes 8. The longer you leave it, the faster it grows. On paper, it looks effortless. Invest early, stay invested, and wealth builds slowly at first, then explosively later. But there's a problem. Most of the rewards come after most people lose patience. This is the time paradox. The power of compounding works best when you give it time, yet the human tendency is to quit before the real payoff begins. People understand compounding in theory. They've seen the graphs. They've heard the stories about Warren Buffett making most of his fortune after turning 60. They nod at the idea that time in the market beats timing the market. But in practice, compounding feels unrewarding for years. The early gains are so modest they barely register. A $5,000 investment growing at 7% per year becomes $5,350 after 1 year. After 2 years, it's $5,724. That doesn't feel like wealth creation. It feels like watching paint dry. Most people want to see results fast. If they're investing monthly, they check their account and wonder why it's not moving much. They question the strategy. They compare it to someone who took a risk and doubled their money overnight. They consider switching. They feel like they're falling behind. So they stop, or they chase something else. They interrupt the process just when it's starting to work. That's the trap. Compounding is backloaded. The early years look unimpressive. The real acceleration comes much later. You might invest for 10 years and feel like nothing's happening. Then in year 15 or 20, the numbers suddenly jump. It's not that the investment changed. It's that time did its work. But you only get there if you stay the course long enough to see it. Take an example. Say you invest $10,000 at 7% annual returns. In 10 years, you'll have just under $20,000. Not bad, but hardly life-changing. Now let it sit for 30 more years without touching it. That $20,000 becomes nearly $150,000. Most of the gains, more than $130,000, came after the first decade. The final years are where the real growth shows up. And that's the paradox. The greatest rewards come at the point where most people would have already stopped watching. Buffett's wealth is often used to illustrate this. He's widely respected for his skill, but the real driver of his fortune is how long he's been investing. He bought his first stock at age 11. He's still investing well into his 90s. That's over 80 years of compounding. Most of his net worth came after he turned 50, not because his returns improved, but because time finally caught up to the math. But holding that long is hard. Life gets in the way. You lose your job. You need the money for a down payment. The market drops and fear takes over. You read an article that questions the whole strategy. You see someone else getting rich quick. All of these pressures make it difficult to wait long enough for compounding to work. The strategy is simple. The execution isn't. Even worse, modern culture encourages impatience. Everything is faster now. Food, information, communication. We get answers instantly. We expect feedback quickly. So when an investment doesn't perform in a few months or even a few years, we question it. Social media magnifies this. Someone posts their winning trade. Another shows off their new car bought with crypto gains. Your slow-growing index fund feels foolish in comparison. You start to wonder if compounding is just a myth. It's not. It's just slow. This is why most people don't build wealth through compounding, even though the math is available to everyone. It requires consistency without reward. It requires trust in something you can't feel yet. It demands that you ignore distractions, headlines, and even your own instincts. It asks you to do less, not more. That's difficult in a world that rewards action. People often make the mistake of trying to accelerate compounding. They think they can jumpstart the process by chasing higher returns. They move from a 7% fund to something promising 20%. Sometimes it works. Usually it doesn't. They end up losing money, resetting the clock. Every detour delays the effect. Every withdrawal steals from the future. Every restart means starting small again. That's another part of the paradox. You can't rush compounding. You can't hack it. You can't push it into high gear by throwing money at it or trying harder. It follows its own pace. You either give it time or you don't benefit. It's like planting a tree. Watering it 5 times a day won't make it grow faster. It grows at its own speed. What matters is not the intensity of your effort, but the consistency of your patience. Some investors don't quit entirely. They just pause. They take breaks. They skip contributions for a few years. They dip into their accounts for vacations or new gadgets. Feels harmless, but even small disruptions can cost huge amounts over time. The missing years at the start matter more than you think. A person who invests $5,000 per year from age 25 to 35 and then stops entirely will often end up with more money than someone who starts at 35 and contributes for the next 30 years. That's how front-loaded compounding is. Time matters more than amount. This also affects retirement planning. Many people delay saving until their 40s. They tell themselves they'll make up for it later. But by then, they've missed the most powerful years of compounding. Even doubling their contributions may not catch up. The early years aren't just helpful, they're essential. They lay the foundation. Once lost, that time can't be recovered. The same principle applies outside of finance. Skill development, careers, relationships, all of them benefit from compounding. Small habits repeated over time lead to outsized results. A person who reads 10 pages a day may not seem different at first, but after 10 years, they've read hundreds of books. The gains come late. The visible benefits trail the invisible effort. And because they come late, many give up early. That's what makes compounding feel unfair. It rewards those who wait, not just in time, but through years of seeming stagnation. It gives its biggest prizes only to those who need them least, those who've already waited the longest. The early years test your resolve. They give nothing back. They feel like failure, but they are, in fact, the most valuable. The time paradox of compounding isn't about math. The math is obvious. It's about patience. It's about belief in a process that hides its results. The returns aren't linear. They're exponential. But exponential growth always starts slow. And in a world that rewards speed, that's the hardest part to accept. A financial bubble is a strange thing. You can see it forming. The signs are there: rising prices divorced from fundamentals, speculative buying, the fear of missing out driving irrational behavior. History gives you plenty of examples. You recognize the pattern. But even when the bubble is obvious, you can't say when it will end. You know it will pop. You just don't know when. That's the bubble paradox. The clearer a bubble becomes, the harder it is to predict its collapse. You can spot a bubble by how people talk. Everything becomes about price. Not value, not income, just price. In a housing bubble, everyone talks about how much their home has appreciated. In a stock bubble, people stop asking about profits and start asking how quickly a stock can double. During the dot-com boom, the phrase "new economy" became a justification for abandoning earnings altogether. It didn't matter if the company had revenue. What mattered was clicks, users, growth, anything that could suggest a big future. When prices rise fast enough, the story justifies itself. People stop asking why and focus only on how high. But even as things look irrational, prices keep going up. That's what makes bubbles so hard to resist. Being early is the same as being wrong. You might identify the bubble correctly, but if you act on it too soon, you miss out, or worse, you lose money while others get rich. Imagine you spot a tech stock that's overvalued. You short it at $80. Then it goes to $150. Then $300. You were right eventually, but if you had limited capital or a stop-loss order, you got crushed long before the bubble popped. Markets don't move on logic alone. They move on behavior, and during bubbles, behavior breaks from reality. Investors buy because others are buying. They believe in momentum. They believe that someone else will pay more tomorrow. That's the greater fool theory in action. As long as you're not the last one holding the asset, you win. And for a while, that works. The Bitcoin rallies offer a modern case study. In 2017, the price soared to nearly $20,000. Commentators called it a bubble. Then it crashed below $4,000. They said the bubble had burst. Then it rallied to over $60,000 in 2021. Was the bubble back? Or was it the same one, expanding further? It dropped again, then recovered. At every stage, people called it a bubble, and at many stages, they were right. But timing the collapse proved nearly impossible. Even now, debates continue. Is it overvalued? Is it underappreciated? Bubbles don't end with clarity. They end with a break in belief. Housing markets show the same pattern. Before the 2008 crisis, home prices rose for years. People warned of a bubble as early as 2003. But prices kept rising. Lenders kept lending. Buyers kept buying. Fundamentals were stretched, but momentum carried the market forward. It wasn't until mortgage defaults surged, credit froze, and trust broke that the market collapsed. The warnings were early and accurate, but most who acted on them before the break missed years of upside or were dismissed as alarmists. That's the core problem with bubbles. Recognition doesn't equal timing. Markets can stay irrational longer than you can stay solvent. And in the meantime, you're under pressure. Everyone else is making money. You look cautious or even foolish. You get asked why you're sitting on cash. You watch gains go by. You doubt yourself. And when the bubble does pop, it's not clean. Prices don't fall all at once. They grind down. They bounce. They trap short sellers and lure back buyers. Popping isn't instant. It's a process. There's also the problem of incentives. In a bubble, people benefit from it continuing. Investors, fund managers, banks, media, everyone profits as long as the market keeps climbing. So there's little reason to call a top. Anyone who does risks ridicule. And even if you're right, you're fighting the tide. The dot-com boom made stars out of analysts who pitched speculative IPOs. The ones who warned of froth were ignored until it was too late. The bubble paradox doesn't just trap individuals. It traps institutions. Central banks see the warning signs but hesitate to act. Regulators know leverage is building but don't want to spook the market. Politicians enjoy the illusion of prosperity. Everyone has a reason to let it go a bit further. And each delay makes the burst worse. But the burst does come. It always comes. Bubbles don't end with moderation. They end with a break, something that causes belief to collapse. It might be a rate hike. It might be a scandal. It might just be fatigue. But when it happens, buyers vanish. Liquidity dries up. Sellers outnumber takers. Prices fall fast and then faster. What took years to build can unwind in weeks. This collapse often feels sudden, but it's not. It was building all along. You just couldn't say when the last bid would disappear. And even after a collapse, people rewrite the story. They say it was obvious. They pretend they knew all along. But most were either swept up in it or stayed out entirely. Few timed both the entry and exit right. That's the cruel joke of bubbles. Being right about them often brings no reward. You're either early and ignored or late and hurt. Timing is everything, and almost nobody gets it perfect. So what do you do if you see a bubble forming? That's the hard question. Avoiding it entirely may mean sitting out for years. Shorting it means risking ruin. Participating in it means dancing close to the edge. Some try to ride the wave with stop losses or trailing exits. Others set strict valuation rules and exit when those are breached. But even then, you're exposed to being wrong for long periods. You look out of touch while others are making money. The paradox doesn't end when the bubble bursts. Afterward, disillusionment sets in. People swear off the asset class. They become hyper-cautious. They say they'll never fall for it again. But memory fades. A new story appears, a new generation enters, and the cycle begins again. Because bubbles aren't just financial phenomena, they're psychological. They are driven by belief, momentum, greed, and fear. And those don't change. You can study the history. You can recognize the pattern. You can stay grounded in fundamentals. But the moment of the pop, the moment remains out of reach. It doesn't flash a warning. It doesn't give you time to prepare. It just happens. And when it does, all the clarity of hindsight kicks in. That's the bubble paradox. You can know you're in one. You can be certain it will end, but you still won't know when. Interest rates are the price of borrowing money. When central banks cut them, they make it cheaper to take on debt. This is meant to encourage spending, investing, and hiring. Businesses borrow to expand. Consumers borrow to buy homes and cars. Investors shift money into riskier assets. Lower rates grease the gears of the economy. In a slowdown, they are a lifeline. They help turn recessions into recoveries. That's the theory. But there's a problem. Cheap money doesn't just help the real economy. It also pours into financial markets. It drives up the price of stocks, real estate, and anything else people believe will hold value. Over time, this can inflate dangerous asset bubbles. That's the interest rate paradox. Rates are lowered to boost growth, but those same low rates can distort markets and create new risks. After the 2008 financial crisis, central banks around the world slashed interest rates. The Federal Reserve dropped its benchmark rate to near zero. The goal was to stimulate recovery. People had lost jobs. Lending had frozen. Confidence was gone. Low rates were meant to restore demand. They worked. Slowly, the economy picked up. But something else happened too. Stocks entered a historic bull market. Real estate rebounded. Bond yields fell, pushing more investors into equities. Riskier assets surged in price. This wasn't a coincidence. When safe assets like savings accounts or government bonds offer almost nothing, people search for return elsewhere. They buy stocks even if prices are high. They invest in real estate even if yields are low. They chase returns wherever they can find them. That demand pushes prices up. And as prices rise, more investors jump in, afraid of missing out. The dynamic feeds on itself. The market no longer reflects just company earnings or property value. It reflects the artificial influence of cheap credit. The real danger is that these bubbles often look like success at first. Rising asset prices create a wealth effect. People feel richer. They borrow more. They spend more. This supports short-term growth, which reinforces the decision to keep rates low. But underneath, imbalances grow. People take on more leverage. Investors take on more risk. Valuations stretch further from fundamentals. And when the tide turns, when rates eventually rise, or when confidence cracks, the fall can be sharp. The housing market is a clear example. After 2008, interest rates stayed low for years. Mortgage rates dropped. Monthly payments became more affordable. That helped homebuyers and lifted the housing market. But it also sparked a wave of speculation. Investors bought second and third homes. Institutional money moved into residential property. In many cities, prices outpaced income growth. Homes became less about shelter and more about investment. When rates began to rise again, affordability dropped. In some markets, activity stalled. In others, prices corrected. Stocks saw the same pattern. For over a decade, central banks kept rates low and sometimes used quantitative easing to inject even more liquidity into the system. That money flowed into markets. Companies with weak fundamentals but strong narratives attracted capital. Tech stocks soared. Startups raised money at inflated valuations. Retail investors, enabled by zero-commission trading and encouraged by rising prices, piled in. The market rewarded growth and momentum, not always profits or discipline. Low rates can also distort corporate behavior. When borrowing is cheap, companies are more likely to issue debt, not just to invest in growth, but to buy back their own stock. Buybacks reduce the number of shares on the market, which boosts earnings per share, even if actual profit hasn't changed. This can drive stock prices higher, benefiting executives with performance-linked pay. but it doesn't always improve the underlying business. It's financial engineering made more appealing by low rates. Private equity behaves differently when debt is cheap. Leveraged buyouts become easier to finance. Valuations climb as firms bid more aggressively for targets. The return calculations hinge on cheap borrowing. If rates rise later, the math no longer works. Refinancing becomes harder. Exit opportunities shrink. What once looked like a good deal turns into a problem. The strategy only works as long as rates stay low. Even venture capital is affected. Low rates reduce returns on traditional investments, making speculative tech plays more attractive. Money flows into startups chasing scale at any cost. Growth before profits becomes the mantra. Companies delay monetization. They burn cash. They focus on user acquisition. This approach can produce innovation, but it also fuels hype cycles. The result is a flood of capital chasing a few winners and many unproven ideas. When rates rise, that dynamic unwinds fast. Investors demand profitability. Startups cut spending. Valuations collapse. Low rates also influence investor psychology. They change what people consider risky. In a normal rate environment, a 5% bond looks appealing. In a low-rate world, 5% return requires much more risk. That shift isn't always obvious. Investors gradually move into high-yield debt, emerging markets, and speculative equities. Portfolio risk increases, but the perception of risk doesn't rise at the same pace. When volatility returns, the losses are larger than expected. People are surprised not because the assets were inherently risky, but because low rates mask that risk. Pension funds and insurance companies face their own challenges. These institutions rely on predictable returns to meet long-term obligations. When interest rates stay low for too long, their models break. They can't generate enough income from bonds. They're forced to chase higher returns, often in less liquid or more volatile markets. This can lead to systemic risk. If enough institutions are stretched, a shock can ripple through the financial system. Central banks are aware of these problems, but their tools are blunt. If they raise rates too soon, they choke off growth. If they raise them too late, bubbles inflate further. And once rates are low, they become hard to normalize. Markets get used to easy money. Any sign of tightening triggers sell-offs. The taper tantrum of 2013 showed this clearly. The Fed hinted at slowing its bond purchases, and global markets reacted sharply. Investors had become addicted to low rates, and even a small change caused fear. This makes central banking harder. Policy meant to stabilize the economy can unintentionally destabilize markets. That's the paradox. Low rates help avoid recessions, but they also plant the seeds for future instability. The more reliant the economy becomes on cheap credit, the more painful it becomes to remove that support. In effect, each cycle of low rates makes the system more fragile. The interest rate paradox is a warning. It shows that policy decisions can have side effects that aren't immediately visible. Helping the economy today can create problems tomorrow. Stimulus meant to prevent downturns can inflate markets that are unsustainable. Investors, businesses, and governments all respond to incentives, and low rates create powerful ones. They encourage borrowing, leverage, and speculation. And while the first phase feels like growth, the second can feel like collapse. Insiders sit at the heart of a company. They know more than any outsider could. They see the operations, the real numbers, the internal discussions. They don't rely on quarterly filings or earnings calls. They live the business day to day. When they buy or sell stock, investors pay attention. The logic is straightforward. If the CEO or CFO is buying shares with their own money, it must be a good sign. They must believe the stock is undervalued. If they're selling, maybe trouble is coming. But the relationship isn't that simple. Insider trades can be noisy, inconsistent, and hard to read. That's the insider paradox. Insiders know the most, yet their trades don't consistently predict where the stock is going. In theory, insider buying should signal confidence. These are people who know the product pipeline, the contracts in negotiation, the hiring trends, the customer feedback. They should have the best information, and sometimes they do. If a cluster of senior executives buys heavily right before a strong earnings surprise, the stock may jump. But these moments are rare. Most insider activity is more mundane. A single director buys a modest amount. A VP sells shares they received as part of a compensation package. A CEO sells for estate planning. Each of these moves is legal, and each one muddies the waters. Insider selling, in particular, is difficult to interpret. People sell for many reasons. They may need to diversify. They may want to buy a home, pay taxes, or reduce concentration. Selling doesn't always mean they expect bad news. Sometimes it means nothing at all. A founder with 80% of their net worth in company stock will eventually need to sell, even if they believe in the business. If you read too much into that action, you may misjudge the situation. Buying can be just as ambiguous. Insiders may buy shares to send a message. They want to show confidence. They want to calm investors after a sell-off. But that doesn't mean the fundamentals are improving. They might believe in the long-term story while knowing short-term problems are unresolved. Their buying may reflect hope, not certainty. It may be symbolic, not predictive. There's also the issue of timing. Even when insiders are right about the direction of the business, the stock may not follow in the same time frame. A CFO may buy stock because they believe new product lines will boost revenue in 2 years. But if the market is focused on current earnings, the price may fall in the meantime. The insider was right in substance, but wrong in timing. For investors trying to profit from insider moves, that's a problem. The trade didn't work, even though the logic was sound. Regulations add another layer. Insiders can't buy or sell whenever they want. They're restricted by blackout periods and disclosure rules. They have to report trades through Form 4, which becomes public within days. That means by the time you see an insider's trade, it's already done. The price may have moved. The edge is gone. And because they're limited in how and when they can trade, insiders often act cautiously. They may not take full advantage of their insight. They may spread purchases over time or stick to small amounts to avoid drawing attention or triggering compliance flags. Academic research reflects this paradox. Studies show that insider buying has some predictive value, but it's modest. It works better when multiple insiders buy at once, especially after a price decline. Cluster buying can be a more reliable signal, but even then, it's not a guarantee. Insider trades improve odds. They don't offer certainty. As a signal, they're one of many alongside valuation, momentum, macro conditions, and market sentiment. Some investors try to build strategies around insider activity. They follow the filings. They look for patterns, but results are mixed. A strategy that buys after every insider purchase will underperform one that filters for size, frequency, and context. Buying $5,000 of stock isn't the same as buying $500,000. A CEO doubling their stake means more than a director making a token gesture. But it takes work to separate signal from noise. And even then, the future remains uncertain. There's also a psychological element. Investors love stories. An insider buying shares fits a simple story. They know more than me and they're buying. I should follow. It feels like getting a glimpse behind the curtain. But that simplicity can be misleading. The insider may be wrong. They may be overconfident. They may be misjudging how the market will respond. Knowing the business doesn't mean knowing the stock. Price reflects more than operations. It reflects expectations, perception, and positioning. During crises, insider behavior becomes even harder to read. In a downturn, insiders may buy to show faith or to stabilize a collapsing stock. Their motives can blur. Investors want to see confidence, but they also want honesty. A CEO who buys shares while cutting staff may appear strong or tone-deaf. The context matters. Insiders are not immune to bias. They believe in their company. That belief can cloud judgment. They may underestimate risks. They may overrate their prospects. Their trades reflect those biases. Just like any investor, they bring emotion to the table. They may feel pressure to support the stock. They may want to prove something to the market. These motivations aren't always rational. They're human. In some cases, insider trades are just part of a plan. Executives set up automatic selling programs known as 10b5-1 plans. These schedules execute trades at preset times, regardless of news or performance. The goal is to avoid the appearance of trading on non-public information. But to outside observers, it can be hard to tell the difference. A steady stream of sales may look like a red flag, even if it's just part of a plan set months ago. Ultimately, insider trades offer a sliver of insight, not a roadmap. They can confirm a thesis or add weight to a decision, but they shouldn't be used in isolation. The paradox is that the people with the most knowledge often trade for reasons that have little to do with that knowledge. They act with constraints, motives, and blind spots. And while their actions are worth noting, they aren't always worth copying. Efficiency means doing more with less. It means faster processes, leaner operations, tighter margins. From factories to financial markets, from global supply chains to data centers, modern systems are built to squeeze out waste. Every step, every resource, every delay optimized. The result is often higher profits, lower prices, and faster delivery. But there's a catch. The more efficient a system becomes, the less room it has for error. The buffer disappears. The slack is removed. There's no cushion. That's the efficiency versus stability paradox. In chasing maximum performance, we often remove the very things that help us survive disruption. This trade-off plays out clearly in supply chains. For decades, manufacturers embraced just-in-time, JIT, inventory systems. Instead of keeping large amounts of stock, they relied on precise timing. Parts arrived exactly when needed. Storage costs dropped. Working capital improved. It was a model of efficiency, but it also meant that any disruption, whether labor strikes, shipping delays, could shut the whole system down. There was no extra inventory to fall back on. During the COVID-19 pandemic, the risks became visible. Factories halted because a single component was stuck at a port. Supermarkets ran out of staples. Car companies paused production due to chip shortages. The system was optimized for speed, not for shocks. The financial world offers another example. In the quest for faster execution and tighter spreads, markets embraced high-frequency trading and algorithmic strategies. These systems route trades in milliseconds. They lower costs and improve liquidity under normal conditions. But in times of stress, they can magnify volatility. When prices start moving fast, algorithms respond faster. They withdraw liquidity, chase momentum, or trigger feedback loops. The 2010 flash crash exposed this fragility. Stocks plunged and recovered within minutes, with no underlying reason. The system worked perfectly until it didn't. Banks followed a similar path. In the years before the 2008 financial crisis, financial institutions streamlined operations, increased leverage, and expanded credit. Risk was sliced up, repackaged, and sold. Mortgage-backed securities promised safety and return. Capital requirements were optimized to the letter, but the structure was brittle. It depended on housing prices rising forever and borrowers never defaulting all at once. When reality shifted, the entire system cracked. The banks had been efficient but not resilient. This pattern holds in energy systems. A power grid optimized for cost savings may not have enough redundancy. Every transmission line, every generator, every control center runs close to full capacity. That keeps prices low and utilization high. But it leaves little margin for error. A heat wave, a cyber attack, or a mechanical failure can lead to cascading outages. The Texas power crisis in February 2021 showed what happens when an efficient grid isn't prepared for rare but severe conditions. Blackouts spread across the state. Water systems failed. The grid had no backup because backups are inefficient by design. The paradox also shows up in organizations. Lean companies reduce headcount, flatten structures, and cut spending. They're agile, profitable, but they rely on everyone doing their job perfectly. When a key person quits or gets sick, things slow down. Institutional memory disappears. Projects stall. A team built for efficiency can't easily absorb surprise. In contrast, a company with some redundancy, overlapping roles, slack time, cross-training, might appear bloated in calm times but proves more stable during disruption. Airlines operate at the edge of this paradox. They use algorithms to maximize seat utilization. Planes run full. Staff are scheduled to the minute. Everything is designed to reduce cost per mile. But when a snowstorm hits or a computer system fails, the delays ripple through the entire network. There are no spare crews, no extra planes. One missed connection leads to dozens of cancellations. Passengers feel the downside of hyper-efficiency. What saves money day to day causes chaos when conditions shift. Even in agriculture, the trend toward monoculture, planting a single crop over vast areas, is driven by efficiency. It simplifies planting, harvesting, and pest control. It boosts short-term yields, but it weakens the system. A single disease, a drought, or a supply shock can wipe out entire harvests. Diversity, which is less efficient, provides resilience. It spreads risk, but it costs more and is harder to manage. Software development and digital infrastructure follow similar lines. Engineers streamline code, remove redundancies, and rely on centralized services. This lowers hosting costs and improves performance. But it also introduces single points of failure. If one cloud provider goes down, thousands of services can fail. If a dependency is compromised, the damage spreads fast. Efficient systems often lack the independence to isolate and contain problems. Part of the issue is that fragility hides in success. When things are going well, efficient systems look invincible. They produce more with less. They cut costs. They outperform. And because they perform so well during normal times, it's easy to assume they'll hold up under stress. But stress doesn't show up in a spreadsheet. It shows up in extreme events, low probability, high-impact disruptions, the very ones we tend to dismiss as rare. In nature, stability often comes from what looks like waste. A tree drops thousands of seeds knowing most won't survive. A body stores fat not because it's efficient, but because it needs energy reserves in lean times. Ecosystems maintain diversity not because it's the most productive, but because it's the most adaptable. These traits aren't lean, but they last. Natural systems sacrifice short-term efficiency for long-term resilience. That's the lesson modern systems often forget. The pursuit of efficiency can strip away the slack that absorbs shocks. It removes the margins that catch mistakes. It pushes operations to the edge, where the smallest error triggers failure. In doing so, it increases the stakes of normal fluctuations. What used to be manageable becomes a crisis. What used to bend now breaks. This doesn't mean efficiency is always bad. It has brought immense benefits, lower costs, higher output, better access. But it comes with trade-offs. And those trade-offs become dangerous when we forget they exist. Building stability means accepting some inefficiency. It means paying for redundancy, holding inventory, cross-training teams, tolerating idle capacity. These things look like waste until they're needed. Then they look like foresight. The paradox lies in the mismatch between what works today and what survives tomorrow. An efficient system wins in calm conditions. A stable system survives the storm. Most systems try to be both, but as they optimize for one, they often weaken the other. The more efficient they become, the less room they have to recover. The paradox is that our efforts to build perfect machines can leave us with brittle ones. And when pressure hits, what we removed for the sake of performance is exactly what we needed to endure. Safe assets are the bedrock of finance. They protect capital. They anchor portfolios. They offer reliability in a world full of risk. Treasury bonds, high-grade government debt, certain types of cash equivalents, these instruments are considered nearly immune to default. In crisis, investors run to them. In uncertainty, they serve as a store of value. They don't offer high returns. That's not their job. They offer safety. But when everyone runs to the same so-called safe asset, something happens. Prices rise. Yields fall. Liquidity dries up in the wrong places. Distortions build. A market designed to offer stability becomes the epicenter of crowding, fragility, and, in extreme cases, failure. This is the safe asset paradox. The more people believe in the safety of an asset and crowd into it, the less safe that asset becomes. The paradox begins with demand. In uncertain environments, capital floods toward perceived safety. U.S. Treasuries are the prime example. During global stress, wars, recessions, pandemics, investors buy treasuries not for return but for survival. That demand pushes prices up and yields down. In the short term, that's fine. But over time, when everyone does the same thing, the safety net gets stretched thin. At extremely low yields, treasuries stop acting like a source of income and start acting more like cash with duration risk. Investors still hold them because they think they're safe, but they now face new dangers like inflation eroding real returns or interest rate shifts triggering price declines. The asset still seems safe, but its behavior has changed, and most investors don't adjust. They keep treating it like a no-risk option. The 2020 to 2021 bond rally is a good example. Central banks slashed interest rates to support the global economy. Investors rushed into government bonds. Yields on some 10-year sovereign debts dropped near or even below zero. At those levels, the upside was gone. Bonds offered no cushion. Yet investors continued to pile in, not because the assets were attractive, but because they were safe. When inflation returned in 2022 and rates rose quickly, those same bonds lost value fast. The safety they promised vanished. People who thought they held low-risk investments watched their portfolios take unexpected hits. Liquidity is another issue. Safe assets are assumed to be easily tradable. They're the assets you can sell quickly when you need cash. But that assumption breaks down when everyone wants to sell at once. During the 2008 financial crisis, parts of the mortgage-backed securities market, previously rated as ultra-safe, froze. Investors realized too late that their safe assets were only safe when no one else needed to sell. The market couldn't absorb the volume. Buyers vanished. Prices fell off a cliff. The paradox isn't limited to bonds. Money market funds are also seen as safe. They aim to keep a stable value, typically $1 per share, and invest in short-term, high-quality debt. But even these instruments have broken under pressure. In 2008, the Reserve Primary Fund broke the buck after exposure to Lehman Brothers. That triggered a run. Investors panicked. Regulators stepped in. It was a rare event, but it exposed the fragility hidden in crowd behavior. When everyone believes they can exit safely, no one is prepared for the moment they can't. Even in equities, the same dynamic plays out. Certain large-cap stocks, mega-cap tech, consumer staples, or defensive sectors are seen as safe havens. They have strong balance sheets, stable earnings, global reach. Investors buy them during uncertainty. As the crowd piles in, prices rise. The stocks become more expensive. The perceived safety gets priced in. At a certain point, valuation risk becomes the new danger. A safe stock trading at 40 times earnings isn't safe anymore. It's fragile, because any disappointment leads to a sharp drop. It's not the business that's risky. It's the expectation baked into the price. Gold offers another angle. It's considered a hedge against currency collapse, inflation, and political instability. In times of fear, investors turn to it. But gold doesn't generate income. It just sits. Its price is driven entirely by belief that others will also see it as a store of value. When that belief becomes consensus, the trade gets crowded. And when something changes, interest rates rise, inflation cools, or the dollar strengthens, those who ran to gold often rush back out. The asset didn't become less stable. The crowd just changed direction. The safe asset paradox becomes more dangerous when institutions are involved. Banks, insurance companies, pension funds all hold large amounts of safe assets. They use them to match liabilities, satisfy capital requirements, and manage liquidity. When these assets perform as expected, the system works. But when crowding leads to overexposure, or when correlations shift, the safety can disappear. In early 2023, Silicon Valley Bank failed, in part due to large holdings in long-dated treasuries and mortgage securities. These were seen as safe. But when rates rose, their value fell. SVB had to sell at a loss. That loss triggered deposit outflows. The assets weren't bad. They were misaligned with the bank's liquidity needs. The assumption that safe assets could cover obligations failed under stress. Crowding also distorts policymaking. When everyone wants to hold the same safe asset, governments and central banks may feel pressured to meet that demand. They may expand issuance, adjust regulations, or intervene in markets. This creates moral hazard. It encourages the belief that safety will always be guaranteed. That belief reinforces crowd behavior. It builds systemic risk. The paradox deepens because investors rarely question the herd. Safety feels strongest when everyone agrees. When a consensus builds around an asset class being low risk, few look closer. Few ask, what happens if everyone tries to exit at once? What happens if yields rise? What happens if inflation returns? The very consensus that makes the asset feel secure becomes the fuel for its instability. This isn't just theory. Financial history is full of moments when the safest assets became the source of crisis. Not because they were flawed, but because the crowd turned them into something they weren't. Stability depends not just on the asset itself, but on how it's used, how it's priced, and how quickly sentiment can change. The safe asset paradox reminds us that no asset is safe in isolation. Safety is contextual. It depends on liquidity, price, timing, and crowd behavior. An asset that's safe for one investor at one price can be dangerous for another when expectations shift. The more universally accepted something becomes as a safe place to park capital, the more vulnerable it is to the effects of overconfidence and crowding. Risk doesn't just come from volatility or default. It comes from assumptions. And the assumption that safety is permanent is one of the most dangerous in finance. The moment you stop questioning the risk is the moment it starts growing. Safe assets work until everyone believes they're guaranteed. That belief is what makes them unsafe. Saving is good. That's what most people are taught. It shows discipline. It builds security, prepares for emergencies. Households that save can invest, handle shocks, and plan for the future. On an individual level, saving is a wise financial move. But if everyone saves at the same time, especially during a downturn, it can damage the entire economy. That's the saving paradox, also known as the paradox of thrift. What's good for one person becomes harmful when everyone does it at once. The logic behind saving is simple. You earn money, spend some, and put the rest aside. That saving can be used later for consumption, investment, or retirement. But your spending today is someone else's income. If you go out less, buy fewer goods, delay repairs, or skip upgrades, the businesses you would have paid earn less. Their employees see fewer hours. Their suppliers sell fewer materials. The money you keep in the bank is money that doesn't circulate. Multiply that behavior across millions of households, and the economy starts to slow. In a recession, people naturally become cautious. Job losses rise, incomes shrink, uncertainty grows, so people respond logically. They cut back on spending and increase savings. They prepare for the worst. This makes perfect sense for each household. But when everyone cuts back at once, total demand across the economy drops. Businesses see falling sales. They reduce staff or close entirely. Unemployment rises further. Fear increases, and the cycle deepens. The effort to protect individual finances ends up hurting the collective economy. This feedback loop is what turns a downturn into a prolonged slump. The original shock, whatever caused the recession, is made worse by a collapse in demand. The economy contracts not just because of the initial hit, but because consumers retreat. Even people who still have jobs and income pull back. They don't know what's coming, so they save more. And that drop in spending ripples through every industry. Consider a basic example. A small town experiences a factory closure. Hundreds of workers lose their jobs. Families in the area start saving aggressively. They stop eating out. They delay car repairs. They skip vacations. The local restaurants, garages, and hotels see revenue fall. To cope, they lay off staff. More people lose income. Those people, in turn, spend even less. Now the slowdown isn't just about the factory. It's about the entire community reacting by saving more and spending less. The original problem spreads. Fear fuels contraction. The paradox is that these choices, made with good intent, make things worse. If one family saves 20% of its income during a crisis, it may weather the storm better. If every family does the same, the storm intensifies. income across the economy shrinks. The pool of money available for wages, services, and investment dries up. Even though households are saving more, their income is falling faster. In aggregate, total savings may not increase at all because the pie is shrinking. People are trying to protect themselves, but the collective outcome is a slower, weaker economy. This problem is unique to downturns. In a growing economy, saving doesn't have the same effect. One person's saving can be offset by another's investment. Banks lend savings to businesses. Spending keeps moving. But during a recession, borrowing and investment also fall. Businesses don't want to expand. Consumers don't want to take on debt. Even if savings are available, no one wants to use them. The system stalls. Keynesian economics highlights this problem. John Maynard Keynes pointed out that total demand drives output and employment. When private demand falls, government spending should rise to fill the gap. That's the argument for stimulus. Public investment keeps money moving when households and businesses pull back. It gives people income so they can spend again. Without that intervention, the economy risks falling into a self-reinforcing decline. During the Great Depression, this paradox played out clearly. People hoarded money, banks failed, confidence vanished. The result was a collapse in demand that lasted years. Franklin Roosevelt's New Deal programs were partly an effort to counteract the saving paradox. The government stepped in as a spender of last resort. Public works, Social Security, and labor programs injected money back into the economy. More recently, the 2008 financial crisis followed a similar pattern. After the housing bubble burst, households pulled back sharply. Many were over-leveraged. Others were simply afraid. Spending dropped across the board. Businesses laid off workers. Investment froze. The Federal Reserve slashed interest rates, but fear remained high. It took years for demand to recover. Even as savings rates rose, the economy stayed weak because there wasn't enough spending to support full employment. The COVID-19 recession added a new layer. Lockdowns forced people to stop spending. Households saved by default. But the result was the same. Businesses lost revenue. Workers were laid off. Total demand collapsed. This time, governments responded quickly with large stimulus checks, unemployment support, and emergency lending. These measures were designed to break the cycle, to give people money so they could keep spending even while saving. It worked better than in 2008, but the underlying paradox remained. The saving paradox is a reminder that the economy is a system of relationships. Your spending supports someone else's job. Their spending supports yours. When everyone acts in their own best interest, the group outcome can suffer. This is true in other areas as well. If everyone tries to sell a stock at once, the price crashes. If everyone tries to withdraw from a bank, the bank fails. In those cases, individual rationality creates collective instability. Solving the saving paradox isn't about telling people to stop saving. Households need security, but it does mean recognizing that saving alone isn't enough to restore growth during a recession. If everyone cuts spending at once, the economy doesn't recover, it contracts. The solution lies in policies that support demand: fiscal stimulus, job guarantees, infrastructure projects, and safety nets that encourage confidence. When people feel secure, they're more willing to spend. When spending returns, so does growth. This paradox also challenges certain cultural values. In many societies, thrift is a virtue. People are praised for being frugal, for living below their means, for saving for a rainy day. And individually, those are good habits. But in the aggregate, they can slow recovery. The economy doesn't just need savers. It needs spenders, not reckless consumers, but people willing to buy goods, hire services, and invest in their lives. That activity creates jobs, supports wages, and fuels the engine of recovery. Understanding the saving paradox requires thinking beyond personal finance. What's right for you might not work for everyone if everyone does it. That's not a contradiction. It's a systems problem. Economies aren't just collections of households. They are dynamic networks. One person's income depends on another person's choice. And in downturns, the instinct to retreat can deepen the very crisis people are trying to escape. High yield looks attractive. You open a chart and see one bond paying 3%, another paying 9%. One stock yields 2%, another boasts 11%. If you're building an income portfolio, the math seems easy. Why settle for less when you can earn more? That's how it starts. Investors see high yield and assume it means better cash flow, more passive income, and faster compounding. But high yield is rarely free. Often, it comes with hidden risks: credit deterioration, falling asset prices, dividend cuts, or poor fundamentals. Over time, these risks tend to show up not as smaller gains, but as outright capital losses. That's the high yield paradox. The very assets promising high income often destroy the value needed to make that income matter. Start with high yield bonds. Also known as junk bonds, these are corporate bonds rated below investment grade. Companies that issue them tend to have higher debt loads, weaker cash flow, or more unstable business models. The bonds pay more because investors demand compensation for taking that credit risk. If the company stays afloat and makes all its payments, the investor gets a high yield. But that "if" is where the trouble starts. When economic conditions shift, when growth slows, interest rates rise, or the company's earnings disappoint, default risk increases. Bond prices fall. The income may still be coming in for now, but the value of the bond drops on the open market. If the company misses a payment or restructures its debt, the bondholder could lose a big chunk of principal. Imagine buying a bond yielding 10%. You're earning more than triple what a treasury bond pays. But a year later, the bond's price drops by 20% because the market thinks the issuer may not survive the next downturn. That 10% income gets wiped out by a much bigger capital loss. If the company defaults entirely, you could lose most of your investment. The yield never compensated for the real risk. This dynamic plays out in equities too. A company offering a double-digit dividend yield should immediately raise questions. Why is the yield so high? In most cases, it's because the stock price has fallen. Dividends are calculated as a percentage of share price. If the stock trades at $100 and pays a $5 dividend, the yield is 5%. If the stock drops to $50 and keeps paying $5, the yield jumps to 10%. That doesn't mean the company suddenly became more generous. It usually means investors have sold the stock, possibly because they expect the dividend to be cut or the business to deteriorate. Chasing high dividend yields without understanding the business behind them is one of the most common mistakes income investors make. Take the example of a struggling telecommunications company that pays a 12% dividend. On paper, that's appealing. But if revenue is declining, debt is rising, and capital expenditures are eating into free cash flow, that dividend may not last. At some point, the company will need to reduce it. When the cut comes, the stock drops again because income-focused investors flee. You didn't just lose part of your income, you lost capital. You would have been better off with a 3% yield from a company with stable cash flow and a strong balance sheet. This isn't theory, it happens often. Energy companies during the oil downturn, REITs in periods of falling occupancy, financial firms with excessive leverage. What they have in common is that their high yields attract attention, but the risks behind the yield get ignored until it's too late. In many cases, the dividend was unsustainable from the start. The company paid it to signal strength or to keep up appearances. But when business conditions worsened, the illusion cracked. Investors learned that income isn't income if it comes at the cost of capital erosion. Closed-end funds and structured income products also fall into this trap. These vehicles often promise yields of 8%, 10%, or more. They use leverage, derivatives, or aggressive payout policies to generate those returns. But they don't always generate enough income to cover those payouts. Instead, they return capital to investors while calling it distribution. Your account may show a steady stream of cash, but your investment is shrinking. Over time, you realize you were just getting your own money back minus fees under the label of high yield. This paradox becomes even more dangerous in low-rate environments. When interest rates are low, investors stretch for yield. They buy lower-quality bonds. They load up on dividend stocks without looking at fundamentals. They invest in exotic credit instruments they don't fully understand. The demand for yield pushes prices up and yields down, until a shock exposes the risks. Then capital flees, prices collapse, yields spike, but only because nobody wants to buy anymore. The assets become toxic, not rewarding. Preferred stocks and MLPs, master limited partnerships, also illustrate this paradox. Both can offer attractive yields, but both carry risks that traditional investors often overlook. Preferred stocks may have fixed dividends, but they behave more like bonds than common equity. When rates rise, their prices fall. MLPs are sensitive to energy markets and regulation. When oil prices collapse or tax rules change, these income vehicles suffer large drawdowns. The yield looked stable until the environment shifted. One of the biggest traps in the high-yield space is the illusion of control. Investors tell themselves they'll sell before things get bad. They'll monitor the company. They'll watch for signs. But deterioration happens gradually, then suddenly. A bond that trades at 98 today might fall to 90 next week and 75 the week after that. A dividend stock might cut its payout overnight. By the time the red flags are obvious, the market has already priced in the bad news. Getting out without loss is harder than it seems. This doesn't mean all high yield is bad. Some companies can sustain high payouts. Some bonds offer good risk-adjusted returns. But the burden is on the investor to understand what's behind the yield. Why is it so high? What risks are being priced in? Is the income supported by actual earnings and cash flow? Or is it based on hope and leverage? These are questions that must be answered before chasing the number. There's also the issue of reinvestment. Even if a high-yield asset holds its value for a while, the income it produces needs to be reinvested. If future opportunities carry the same risks or deteriorate in quality, the overall portfolio may become more fragile over time. What looks like a strong income stream becomes a compounding of risk. The smarter approach is to balance yield with quality. Focus on companies with strong fundamentals, consistent cash flows, and reasonable payout ratios. Accept a lower yield if it means better capital preservation. Use high-yield assets sparingly, not as the core of a portfolio. Look beyond the surface. High yield is never free. It's payment for risk, real risk, not just volatility. The high-yield paradox teaches that income and total return aren't separate. You can't enjoy high income if capital losses eat away your principal. A 10% yield means little if you lose 20% of your investment. The goal isn't to maximize yield. It's to build sustainable income that doesn't come at the cost of capital. Sometimes that means choosing the lower-yielding option, the one that keeps its value and lets you sleep at night. When a system breaks, someone has to step in. In a financial crisis, central banks and governments often act as backstops. They inject liquidity. They guarantee deposits. They bail out institutions. The goal is to stop panic, preserve confidence, and prevent collapse. Without that intervention, fear spreads. Markets freeze. A bad situation gets worse. Bailouts restore order. They protect jobs, savings, and entire economies. But they also send a message. If you're big enough, important enough, or connected enough, you won't be allowed to fail. That's the moral hazard paradox. The very safety nets that prevent disaster can also reward and even invite risky behavior. Moral hazard arises when people take on risk knowing they won't bear the full consequences of failure. If someone else absorbs the loss, the incentive to act prudently weakens. In finance, this becomes a serious problem. Banks, insurers, and investors operate in a world full of uncertainty. If they believe losses will be socialized while gains remain private, they're more likely to overextend. They issue risky loans. They invest in complex, high-yield products. They stretch leverage. The system becomes more fragile, ironically, because the safety mechanisms are so reliable. The 2008 financial crisis made this paradox visible. Big banks packaged risky mortgages into securities and sold them with high credit ratings. They made billions. When the housing market collapsed, those assets turned toxic. The losses spread quickly through the global financial system. Panic set in. Credit markets locked. The US government responded with massive bailouts, capital injections into major banks, guarantees for money market funds, and an unprecedented $700 billion Troubled Asset Relief Program, TARP. These steps stabilized the system, but they also told Wall Street something else. If the stakes are high enough, the state will step in. Some banks went under, others took losses, but many senior executives kept their jobs. Some firms even paid bonuses after receiving public funds. For ordinary citizens, the message was bitter. The same institutions that caused the collapse were rescued with taxpayer money. Homeowners, on the other hand, faced foreclosure. Job losses mounted. Retirement savings vanished. The public bore the brunt. This imbalance deepened distrust and fed the sense that some actors could gamble without consequence. Since then, regulators have tried to reduce systemic risk. Capital requirements increased. Stress tests became routine. Resolution regimes were built so that even large institutions could fail in an orderly way. But the perception hasn't fully changed. When big banks get into trouble, the market still assumes they'll be rescued. That assumption affects behavior. Risk models bend. Lending standards loosen. Safety nets create a false sense of security, and the cycle begins again. Central banks face their own version of the paradox. In recent decades, especially since 2008, they've acted not just as lenders of last resort, but as buyers of last resort. They purchase government bonds, mortgage-backed securities, even corporate debt. This support stabilizes prices. It reassures markets, but it also distorts incentives. Investors expect intervention. Asset prices reflect that expectation. The result is financial markets that depend on policy, not just fundamentals. This dynamic showed up again during the COVID-19 shock. In March 2020, markets collapsed. Liquidity vanished. The Federal Reserve intervened forcefully. It slashed rates, launched unlimited quantitative easing, and backed credit markets with lending programs. These actions were necessary. Without them, the economy could have imploded. But they also signaled that whenever markets fall fast enough, help will come. That knowledge shapes risk appetite. Traders position for support. Volatility becomes an opportunity, not a threat. Insurance systems reflect the same tension. A company that knows it's insured against loss may take less care to avoid that loss. In banking, deposit insurance prevents runs, but it can also encourage aggressive lending. If customers know their money is protected, they won't care how risky the bank's behavior becomes. That's why regulators impose strict rules on insured institutions. Without limits, insurance can breed the very failures it's meant to prevent. Corporate bailouts raise a different kind of moral hazard. When governments rescue large employers, airlines, automakers, or utility providers, they often justify it by pointing to jobs, infrastructure, or national security. These are valid concerns. But each bailout teaches executives that failure won't be final. They can prioritize shareholders, ignore structural problems, and expect support in bad times. This weakens discipline. Capital gets misallocated. Weaker firms survive not because they're competitive, but because they're protected. The paradox also affects public policy. Politicians want to prevent suffering, but short-term relief can delay necessary reform. If a failing system gets propped up again and again, it never adapts. It becomes dependent. In the long run, that's more dangerous than failure. Markets work best when they reward prudence and punish recklessness. But when losses are absorbed by the public, that discipline fades. Not all bailouts are created equal. Some include strict conditions: equity stakes for the government, leadership changes, limits on dividends and bonuses. These steps can reduce moral hazard. They signal that help comes at a cost. But even then, the precedent is set. Once an institution is saved, others take note. They calibrate their behavior accordingly. The knowledge of past rescues becomes part of future decision-making. There's a deeper problem too. Systemic risk is hard to see in real time. When times are good, excessive risk doesn't look dangerous. It looks profitable. Risk models show low volatility. Profits rise. Leverage seems efficient. The warning signs get ignored. And if regulators are too timid or too captured, they let the buildup continue. Then when a shock hits, the system is so fragile that there's no choice but to intervene. The bailout becomes inevitable, not because the failure was unpredictable, but because prevention failed. That's the heart of the moral hazard paradox. Intervention is necessary when the cost of inaction is collapse. But each intervention makes the next crisis more likely by encouraging behavior that assumes protection. The system becomes trapped in a cycle. Risk leads to crisis, crisis leads to rescue, rescue leads to more risk. Breaking the cycle is difficult. It requires letting failure happen, and that comes with its own costs. The ideal solution is structural. Strong oversight, clear rules, and limited safety nets that prevent contagion without eliminating accountability. But that's a political challenge. It requires balancing economic stability with moral clarity. It means designing systems that don't need bailouts in the first place, and having the courage to withhold rescue when appropriate. Because in the long run, unchecked safety nets don't just prevent failure. They invite it. Simple investing strategies work. They're backed by data, easy to understand, and often outperform complex ones over time. Buy a low-cost index fund, reinvest the dividends, hold it for decades, avoid market timing, stay diversified. That approach beats most active funds. It beats most stock pickers. It beats most traders. And it's not even close. But most investors don't stick with it. They chase complexity instead. They look for secret formulas, algorithms, expert insight, or market predictions. They ignore the simple plan in favor of something that feels more intelligent. That's the simplicity paradox. Simple strategies win, but people crave complexity. It starts with a basic human instinct. People equate complexity with sophistication. A model with more variables must be smarter. A portfolio with more holdings must be better diversified. A strategy that uses advanced math must be safer. In everyday life, complexity often signals expertise. A detailed diagnosis from a doctor sounds more convincing than a simple one. A long explanation from a lawyer seems more authoritative. The same instinct shows up in finance. Investors want to believe that something complicated must offer an edge. But financial markets don't reward complexity the way people expect. Markets are noisy, adaptive, and influenced by behavior. They punish overconfidence. The more moving parts a strategy has, the more things can go wrong. Timing must be perfect. Assumptions must hold. Inputs must stay relevant. And when the market changes, as it always does, the complex model may no longer fit. Meanwhile, the simple strategy keeps working. It doesn't try to predict. It just participates. Consider dollar-cost averaging. You invest the same amount of money at regular intervals, regardless of market conditions. This method doesn't try to buy low or sell high. It buys through highs and lows. It averages out volatility. Over time, it builds wealth. It doesn't require forecasting, technical analysis, or deep research, and it outperforms many more sophisticated strategies that rely on timing the market. Yet it's often dismissed as too basic, too boring. The same applies to index investing. Buying a total market fund or an S&P 500 fund gives you exposure to hundreds of companies. Costs almost nothing. It requires no monitoring, no rebalancing, no insider knowledge. Decades of research show that passive index funds outperform the majority of actively managed funds, especially after fees. But investors still pour money into high-fee funds and hedge funds. They assume complexity means control. It doesn't. It just means more things can break. Active management isn't just more complex, it also plays on ego. It lets people believe they're in control, that they can spot trends before others, that their insight adds value. And sometimes it does, but consistently beating the market is rare. It requires skill, discipline, and luck. Most investors, retail and professional, underperform over time, but they keep trying. Complexity gives the illusion of power. Even outside of asset management, the desire for complex answers misleads. In financial planning, people seek custom strategies, exotic insurance products, and tax structures that sound advanced. But the best advice is often the simplest. Spend less than you earn. Save early. Stay insured. Avoid debt. Invest steadily. Don't panic. That plan works, but it sounds too plain, so people look elsewhere. They hire expensive advisors. They pay for seminars. They chase systems with more steps. And they often end up worse off. Part of the problem is boredom. Simple strategies don't change much. They don't give people something to do. Investors want to feel involved. They want to tweak, adjust, and optimize. They follow the news. They check markets. They make small trades. But every action carries risk. Each decision is a chance to get it wrong. Simple strategies avoid that trap by design. They succeed not by precision, but by consistency. There's also social pressure. Simplicity doesn't impress. Saying, "I own an index fund," doesn't spark interest. Saying, "I'm long emerging markets with a covered call overlay and tail risk hedge," makes people listen, even if the strategy underperforms. Complexity sounds smart. Simplicity sounds lazy, so people dress up their approach. They add layers. They create narratives. They make investing harder than it needs to be. Professionals are vulnerable too. Advisors, analysts, and portfolio managers need to justify their existence. If they recommend a plain index fund and do nothing, clients may question the fee. So they complicate. They add asset classes. They recommend alternative investments. They rebalance more often. They forecast interest rates or market cycles. It creates the appearance of value, even when the results lag behind a simpler benchmark. The simplicity paradox also shows up in backtesting. Many strategies look brilliant in hindsight. They use historical data to build complex rules. Buy when this crosses that, sell when this ratio hits a certain level, rotate sectors quarterly, and so on. The result is a clean chart with high returns. But these strategies often fail in real time. They're overfit. They captured past patterns that no longer apply. The complexity wasn't insight, it was data mining. In contrast, simple rules endure. A 60-40 stock bond portfolio, a target date retirement fund, a regular savings habit. These don't promise to beat the market, but they keep investors in the game. They prevent catastrophic mistakes, and they often outperform the complex strategies that react to every signal. Simplicity trades the hope of outperformance for the reality of staying invested. That trade usually wins. Some of the most successful investors understand this. Warren Buffett recommends index funds for most people. Jack Bogle built Vanguard on the idea that low-cost simplicity beats high-cost complexity. Even Ray Dalio, known for his detailed macro models, emphasizes timeless principles like diversification and discipline. The best in the field don't chase complexity for its own sake. They use it sparingly and only when it adds actual value. Behavioral finance explains part of the paradox. Humans suffer from overconfidence. They think they can do better than the average. They seek patterns where none exist. They believe more information leads to better outcomes. But in investing, more data often leads to more noise. Simpler strategies avoid this trap. They reduce the number of decisions. They remove emotion. And that discipline adds more value than most complex analysis. The problem is that simplicity doesn't sell. It doesn't headline books. It doesn't attract assets. Complexity feels exciting. It gives people a reason to act. And the financial industry is built around giving people something to buy, something to trade, something to believe in. But most of it doesn't work. The simple path is the one most people avoid, even as it passes them by. That's the paradox. The strategy that wins is the one people overlook because it looks too easy.